minutes and just have a little conversation with you guys, things to consider, if you will. So in units 7 and 8, we talked about agency. In units 9 and 10, we talked about contracts. And as mentioned, agency and contracts tend to be heavily tested units. And when we talked about contracts, we talked about the contract formation wall. I think we called it something like that, contract formation wall. And with the contract formation wall, the scenario that we ran in class, and what I'm almost certain you will see on your exam, is the scenario that we're looking at here. So you have the buyer and the seller. The buyer's acting as the offeror. The offeror is the giver of the offer. And then you have the seller, who's the offeree. And then each buyer and seller is represented by a different firm. So you got ABC firm and agent working with the buyer. You got XYZ firm working with the buyer and the seller. And what we talked about specifically with contract formation, the offeror makes the offer to the offeree. The offeree receives an offer and they have three choices. Let's warm up. What are their three choices? The offeree can
Accept, reject, or counter.
or counter it. We're good with that, right? So the offeree always has three choices. If we were going to counter offer, then the roles reverse. The seller becomes the offeror, making the offer to the buyer, the offeree. The buyer's now the offeree, and they have three choices. They can accept it, reject it, and counter it. Understand, nobody's bound to anything until we have acceptance and communication of acceptance. So we have, in this case, no counter offer. We have buyer making the offer. Good morning. Buyer making the offer. The seller accepts. The offeree accepts. In pre-licensing world, what does that mean? If the offeree accepts,
Sign.
it means that they have signed. In pre-licensing world, don't get in your way. Don't sit there and say, oh, was it verbal acceptance or was it written acceptance? For your exams, when you see the word accept, know that it's been signed. Everybody with me? In the real world, you need to verify, but there's real world and there's pre-licensing world. So step one, we have the last offeree sign. And then step two, to form a contract, we need communication of acceptance. I did not say we need to deliver the signed contract. We need to communicate the fact that it's been accepted. And what did we just say it means when it's accepted? That it's been signed. So what are we communicating? We're communicating the fact that it has been signed by the last offeree. And in order for that contract formation, that communication of acceptance must cross the line. The communication must go from the seller, the offeree, the seller, to the firm. If communication happens amongst the agents, so if the listing firm calls the selling firm and says, hey, my guys have signed, we're under contract. Does it matter that the firm or the agent hasn't called the buyer yet and told them the good news?
No.
No, because when it comes to negotiating and contract formation, communicating with me is just as good as communicating with my client. Again, you guys, this is the scenario we ran in class. I'm almost certain this is what you're going to see on your test. This is what you guys saw on your midterm. Did you guys draw it out on your midterm? Or are you drawing it out on your practice questions? So you can see who that last offeree is that needs to sign, and then who needs that communication of acceptance. I recommend drawing it out. You guys saw that problem on your midterm. That sucker was like this long, wasn't it? And you got to figure out in the end who's the last offeree and the last offeror. So that's a nice little, quick little refresh for us. With that being said, now that we've had time to let agency and contracts and 7, 8, 9, and 10 marinate a little bit, with that being said, I just kind of wanted us to take a few steps back and give you some food for thought, give you some things to think about, because not all contract formation is dealing with two different firms. We may have a dual agency situation. We may have a designated dual agency situation, and we may have a seller sub-agency situation. So depending on the agency may affect what our contract formation wall looks like. So this is where we are, two different firms. Again, I'm almost certain this is what you can expect to see on your test. But if we want to take agency and contracts and further understand them, look at the contract formation wall in dual agency. Wait a minute. Where'd it go? Got by accident. Dual agency is only and always about whom, or about what, I should say. Dual agency is always about what?
The firm.
Firm.
The firm. So when the seller tells their agent that they've accepted, that is just as good as telling the buyer. Communicating to me is just as good as communicating to the client. And in a dual agency situation, the contract formation wall goes away because there is no line dividing the buyer and the seller. The buyer and the seller are both equally represented by the firm. Talking to the agent, talking to the firm is just as good as talking to the other side. So in dual agency, we don't have a contract formation wall. Once communication of acceptance is told to the firm, then we are under contract. Or acceptance, yeah. Then we are under contract. Now, with designated, we may also have the option, with dual agency, we may also have the option to offer designated. And in designated, the line comes back because now you have two agents, one working exclusively with the buyer and another one working exclusively with the seller. The firm and all the other agents are still in dual agency, but they bring back the contract formation wall when they chose to be designated. So now these two agents, you guys understand, once these two agents have been designated, these two agents might as well be with two different firms. They might as well be the selling agent with ABC Realty, the listing agent with XYZ, because they were designated and they chose to bring that wall back in between them. The firm is still in dual. The firm and all the other agents are still in dual. But for contract formation, the wall comes back. And these are in the our PowerPoints, by the way, as well, in the online learning system, the Julie folder in the Unit 10 material. And then that third scenario that we have is the seller's subagent. Remember, with the seller subagent is working with a buyer customer. They're not working for the buyer customer. They are working with the buyer customer. They are assisting the buyer customer to get through the transaction because that's what's in the best interest of the seller. They're allowed to hang out on this side of the wall with the seller. So everything that this seller subagent does is what's in the best interest of the seller. So again, the buyer makes an offer, they can make it with the seller subagent. The seller subagent will write it up. They'll present it because that's what's in the best interest of the seller. Seller signs. Seller accepts as the offeree, they accept. Seller tells their agent that they accept. Listing agent probably calls seller's agent, and because they're the ones communicating with the buyer. And then the seller's agent has to have that communication cross the line to the buyer. So that communication, let me do this. That communication, when that crosses the line, may depend on what type of agency we're dealing with. And that's why I put these slides in here, because I do think this is the in practice piece of it. And so I think knowing these are kind of our goals, this is what we're trying to really, really, really get good at understanding. Again, it all starts with understanding, grasping agency contracts, etc. So I just wanted to throw that out there for you guys for food for thought, things to consider. I did hit record. And like I said, these slides are in the online learning system under the Julie folder. This is at the 7, 8, 9, and 10. So I just encourage you to consider it. I always encourage you when you see these questions to draw the line and to spell out who is who, so you can see who the last offeree is and who the last offeror is, so you know who needs to accept and who needs to communicate acceptance. Yeah, Phil?
Yeah, so in the example of dual agency with no line,
Mhm.
the communication of acceptance, when we say it just has to be the firm, does it have to go to the broker in charge or just anybody in the firm?
We all stand here on the firm. We all stand here as part of the
Okay.
firm. So, yep, talking to me is talking to the firm
Thank
because
you.
I stand there on behalf. Thank you. That was a good question.
What can the unprovisional broker do? That confused me on the test because I thought they couldn't really do too much of anything.
A provisional broker, you're right, can't do anything with an inactive license. How does a provisional broker activate their license?
By doing the post licensing and being
No.
under a firm.
No, no.
Affiliating with a
provisional
firm.
broker activates their license by affiliating with a firm. The only thing post licensing does for you is drop that provisional status.
Okay.
So as a provisional broker, you're inactive. You activate by affiliating with a firm. As a provisional broker, once you're affiliated with a firm, you are under the direct supervision of a broker in charge. So once you're affiliated and you're under that supervision as a PB, you can do just about everything that a full broker can do. There are a couple exceptions. We will talk about those when we get to license law and commission rule. But for right now, BJ, an active PB can do just about everything that a full broker can do. That's the trick, though. You got to be under the direct supervision of a broker in charge.
So what about when it said unprovisional?
That's non-provisional. That's a full broker.
Oh, okay.
So you got provisional, and then they like to throw you several different provisional or non-provisional, full broker, broker. Yep.
Okay.
Speaking of your midterm, you guys, I don't know what happened, but you guys, when you got your results for the midterm, you were supposed to get, you all got, from understanding the few of you I've talked to, you guys got kind of a breakdown of the different topics. So it says this is how many you missed from unit 1, how many you missed from unit 2, how many you missed unit 3, and it gave you the percentages. So use that to help you identify your areas of weakness. Your midterm results were also supposed to include the questions that you got wrong. And it's to my understanding that you didn't get that. And I don't know what happened, but what I do know is that Jane is in the throes of ClassMarker trying to fix all this. And I did tell you guys you would get what you got wrong. So I want to make sure you get it. So what I'm going to do is because I got it. I got your breakdown and I got what you got wrong. So I'm going to forward you guys your results because I want you to see what you missed. I want you to see what you got wrong. So I will forward those to you so you have them. Please hear me, you guys. I won't be able to do this today. So tomorrow I will sit down and I'll forward each of you. Just be patient. Again, you guys, you're never going to see these test questions again, but I do understand, and sometimes studying the questions, it can help you better get the answers. Some of you got it, some of you didn't. Well, ain't that something? All right, so I don't know who got it and who didn't, so I'm just going to forward to everybody. You guys can be on the lookout for that tomorrow. Like I said, Jane's in the throes of ClassMarker did like this major upgrade a couple weeks ago, and apparently like everything is different. So Jane's in the throes of relearning ClassMarker. You know, technology is great until they do a major upgrade, and then you got to go back to square one. So interesting that some of you got it and some of you didn't. All right.
You actually had to scroll down. You actually had to keep scrolling to see it, because I wouldn't have saw it had I not kept scrolling. It's not on there. It doesn't tell you it's on there, but right under the breakdown, if you continue to scroll down, then you'll see it.
Pinky, can you forward me yours so I can see what you see, please?
Yes.
And you guys check your email. No, ma'am, I'm sorry. You guys can check your email. And if you have it, great. If not, I will send it to you. I will send it to you tomorrow. So we make sure that you have it. That's correct. There was no math. We tried to make that a little easier on you guys. So no math on the midterm, but you know what? Us instructors at Carolina School of Real Estate, we're in the throes of the discussion of adding math to the midterm. So next year's class probably has to have math on the midterm. That's where we are. Not too many, but just a couple. Okay, so that's where we are. Any questions or comments? Yeah, do I have a question? All right, so we are in the throes of Unit 14, and I need to stop sharing for a second so I can switch out my PowerPoint. So while I'm doing what I'm doing, I want you guys to set your chat to private. And I want all of you to tell me in a private chat, and you can abbreviate, I know what you speak of. What is your debt service? Everybody, private chat, what is your debt service? And if you don't know, say IDK. What is your debt service? And again, you can abbreviate. I know that's a lot to type, so feel free to abbreviate. So your principal and it, no, oh, I just gave you the answer. Dang it, are you kidding me, Julie? I need more coffee. What is your debt service? It's your principal and your interest. Look at you guys coming in now. Oh yeah, it's your principal and interest. Guys, remember the principal and interest is what you owe the bank. The principal is the amount that you borrowed. The principal is the loan amount. The principal is the balance. That's the money that you borrowed from the bank. That's what you promised the bank that you would pay them back. The bank is going to charge you interest for borrowing the principal. So the principal and interest is considered your debt service. And that is, and that is, does not include those taxes and insurance. So remember, every month you send in a mortgage payment or send in a payment, it consists of 4 pieces: principal and interest, taxes, and insurance. The only 2 pieces that are considered your debt service is principal and interest. So that gets us back into financing. So remember the trick, the key to financing. Let's all put our lender hat back on. We can no longer think like brokers in these units because we got to think like a lender, learn how to speak like a lender. And that's what these couple units are doing. So we're in the throes of Unit 15. And we left each other on Tuesday talking about the different loan types. So one loan type or one loan product that we have is the conventional loan. The conventional loan is not backed by a government agency. And what I mean by that, with a conventional loan, the lender bears all the risk. The lender doesn't have a safety net. In the event of the borrower's default, the lender has to collect the money themselves or write it off as a loss, write it off as a debt, if they can't get all they need from foreclosure or short sale, for example. Because the lender doesn't have a safety net, because the lender bears all the risk, when the loan to value ratio is 80% or higher on a conventional loan, then the lender is likely to charge insurance, specifically called private mortgage insurance. Don't let all those fancy words mess you up. It is just insurance for the lender in the event of the borrower's default. So the purpose of insurance remains the same. It's there in case something bad goes wrong, something bad happens. So for the lender, if the borrower defaults, they have insurance. With that loan to value ratio originates under 80%, or if the borrower makes payments and gets it under 80%, then most lenders will drop that PMI because you're not as risky. And then we talked about FHA insured loans. Again, I think these names are very misleading. The FHA is insuring the lender in the event of the borrower's default. FHA doesn't offer homeowners insurance. FHA isn't going to protect you. FHA is insuring the lender in the event of the borrower's default. They're giving the lender a safety net. And they're saying, look, if this borrower defaults, we're here to catch you. We'll help bail you out. Because the government is offering a safety net, the application process, the criteria to get approval for an FHA loan are tighter. The property has to be approved as well. Some conditions may not be approved. You know, we talked about the hoops and the hurdles of the FHA and the VA loan because the government's involved. But one thing I don't think I mentioned, but I do think it's worth mentioning, you know, a perk for an FHA loan. Some lenders will allow a borrower to get an FHA loan with a loan to value ratio of up to 97.5%. So if the lender's loan to value ratio is 97.5%, how much are you bringing if you get approved for that FHA loan? What's your down payment?
3%.
3.5%. Again, who has the bigger interest in this property? I mean, we said your 10% last week was cute. Your 3.5% is just downright adorable. What did that bring to the transaction? Not a whole lot. But that's a huge perk with the FHA loan, is that you may be approved buyers and properties may be able to get in at a much higher loan to value ratio because the lender has that safety net, because the government has insured the FHA loan. The other one we talked about then and where we left each other on Tuesday was talking about our VA guaranteed loan. Again, the VA is guaranteeing the lender in the event of the borrower's default. They're not guaranteeing that the vet will get approved. They're not guaranteeing the eligibility. They are guaranteeing the lender in the event of the borrower's default. It's another safety net. Again, loan to value ratios can be higher when there's a safety net. So it's not uncommon for eligible vets to get 100% financing. 100% financing, what's your down payment? Yeah, that's a big old nada, is it? That's a huge perk, you guys, but there's got to be approvals, not just for the people, but for the property themselves. Good morning. So that's kind of where we left off, talking about the different loan products. And you guys will probably notice that most of these are green stars. Please remember, we're not in lender school. We're just trying to get a very basic understanding of the loan products. Another loan product that may be available is a USDA loan. What do you guys think of with USDA?
Food.
Farm? Yeah. If you think of a big old juicy steak, you're my kind of people, even though it's only 9-something in the morning. That's all right. So with USDA, these are our farms. These are our rurals, our dairy farms, our vegetable farms. These are loans set aside, not just for farms, but these are loans set aside for rural areas. Rural is going to depend on the population. So if the population is less than X amount, it's deemed rural. If the property is in that rural area, the borrower may be eligible for a USDA loan. So it's helped to help support our family farms, our local farms, but it's also meant to help low income to moderate income families and rural properties. You're never going to get a USDA loan in downtown. So with USDA loans, there are a couple perks. And with USDA loans, they may take a 30-year loan and stretch it out to longer. They may take a 30-year loan and stretch it out to 33 or 38 years. What that does is it makes your payments smaller. So they may be able to offer longer than normal repayment periods for eligible borrowers. Low to no down payment. Again, we're trying to help low income to moderate income families in rural areas. If eligible, borrowers may be able to subsidize their interest rates. If you're subsidizing, it's like your college loans, you're not accruing interest. So you may be able to subsidize or prevent interest from accruing for a certain amount of time. You get that principal paid down. When you're working with a buyer that wants to get a USDA loan, you guys will want to go to USDA's website. Please don't do it now. I would consider that a distraction. When you're working with a buyer that wants to get a USDA loan, go to USDA's website. They have a map. You can plug the address in, and it'll tell you right then or there if that property is in a rural area or not. The yellow is not. So if your buyer, and the thumbtack is in downtown Winston-Salem. So if your buyer's going for a USDA loan and they want to see something out here in Louisville or up in Renolda, they're not going to get USDA loan because it doesn't fall within the rural areas. So you'll definitely want to check the map before you take the buyer up to Tobaccoville and show them the property to make sure that it's eligible. This map constantly updates too as populations update. I mean, y'all, look at Rural Hall up here. Rural Hall ain't rural no more, is it? You know, we're growing up in King, 52, that area is exploding up in there, isn't it? So as populations change and adjust, we can expect the USDA map to adjust as well, which is why the suggestion is you look at it each buyer, because it does update. So to be eligible for a USDA loan, the property's got to be in a rural area. The families, again, low to moderate income families, currently not in safe or decent housing, trying to find a house safe and decent, rural area, and they may not have other financing options available. They may want to go for the USDA, or the lender may say, this is all we can offer you. So it's just another loan product. It's another choice. It's another flavor of cereal on the shelf. So the borrower just shops around for what cereal loan they like the best. So it's another product. Also government backed, USDA. Starting on page 423, we talk about other types of loans. And we're going to go through these pretty quickly because we just, again, needed even more basic understanding of these than what we did with the others. Hang on, I got to get my old book out. So old book people, you are on 403. So old book people, I think you're about 10 pages off or so, 20 pages off. So another financing option that the borrower may have is something called a purchase money mortgage. This is important. Purchase money mortgage is seller financing. Purchase money mortgage is seller financing. Seller financing is a purchase money mortgage. Either name is applicable for your exam. They could call it seller financing, owner financing. They could call it a purchase money mortgage. We need to know that one is the same. With seller financing, the seller is acting as the banking institute, which means the buyer buys, they become the owner, and then the payments that they make every month are directly to the seller. We see seller financing some out there still. I'll tell you where I see it the most. Do you ever drive by a big vacant lot and there's a sign on the corner that says like 45 acres plus or minus for sale? And then at the bottom, it might say seller financing available. So I usually see that a lot with big lots, but anybody can offer it. It can be available to everybody. With a purchase money mortgage, the buyer gets the title at closing. So again, it's just like buying a house with Bank of America. You get the title and then you start making those payments to Bank of America. Purchase money mortgage, you get the title, you start making those payments to the seller. Now, back in Unit 10, we introduced you guys to an installment land contract. And with an installment land contract, the buyer is paying the seller. They're not doing it in one lump sum, they're doing it in installments. And it's important that we know the difference between an installment land contract and a purchase money mortgage. And the difference of the two is when the deed changes hands. And the purchase money mortgage, the deed changes hands at closing. And an installment land contract, the deed changes hands when the last installment payment is made. So purchase money mortgage, seller financing. And then we rattle off, again, very basic understandings. A package loan combines real property and personal property. So if you're going to buy a furnished condo at the beach, you would do so with a package loan. I always picture wicker when I say that. If you're buying a furnished condo at the beach, you're going to do it more than likely with a package loan. So there's real property. It combines the purchase of real property and personal property. A bridge loan is a short-term loan. Think like a couple weeks, a couple days. It's meant to fill the gap from one loan ending to the new loan originating. Thinking about what a bridge does. A bridge fills a gap from here to here, right? So we have a gap. This loan ends today and your new loan doesn't originate till Monday. You'll need a gap, and that would be your bridge loan. Blanket mortgages are used when the borrower is purchasing more than one parcel at a time. So think of a developer that's going to buy like 5 pieces of land to combine them and subdivide them and build houses on it. That developer may buy those multiple parcels, those multiple pieces of land using a blanket mortgage. An open-ended mortgage is like a line of credit or equity. You're borrowing against your property. You're using the property as collateral. You got to have equity. You got to have some money into the property so you have something to borrow. Construction loans are used to finance new constructions. With our lender hat still on, construction loans can be really risky because the buyer is asking the lender for money for a product that doesn't exist yet. They're asking the lender, they're standing on a hunk of dirt with a dream and a blueprint, going, give me money. Pretty risky on behalf of the lender, isn't it? So construction loans, often how these are handled is they're given out in chunks at a time. So I'll give you X amount of money, and then I'm going to come check on the progress. And once I see you've reached phase 1, then I'll give you more money to build phase 2. Instead of giving you all the money and letting you run away off into the sunset, we're going to issue these in chunks at a time as construction progresses. Buy downs are just a loan to lower your interest rate. So you can basically get another loan, borrow more on the property, get yourself a lower interest rate. Home equity loans are awfully similar to open-ended mortgages. You're still using the property as a collateral. You're using your equity that you have in the property as a collateral. Really, the big difference is home equity loans tend to be used more to pay off, maybe consolidate debt. Maybe you had some major medical expenses. You want to pay those off. You want to borrow against your home. And then reverse mortgages are exactly how they sound, you guys. Instead of the borrower paying the lender is paying the borrower. Obviously, with reverse mortgages, the borrower has to have equity. They have to have it mostly paid off, if not the only way paid off. So instead of me sending the lender money every month, the lender is sending me money, which is my equity. These programs are usually more often seen and used for seniors and elderly that have their home paid off to help supplement Medicare, Social Security, those other things, help get them some money. You guys probably see commercials for reverse mortgages. Tom Selleck's the new spokesperson, if that didn't make you feel old. But he's got commercials now for reverse mortgages. And again, that's exactly what they are. The lender's paying the borrower. I'm not giving you the lump sum, I'm giving you payments against your equity. So with all these loan types, loan products, again, some lenders have all of these available. Some of them have some of them available. Some of them only have one product available. Just like the real estate firm, all lenders are different. So as buyer's agents, one of the best things that we can do is encourage our buyers to shop around. Talk to 2 or 3 different lenders to see what products they offer, to see what kind of cereal they have, what kind of products they offer, so your borrower can decide what's the best product for them. You guys, some of these mortgage loans are 30-year loans. That's such a commitment. And remember we said the other day, I mean, it's not like our grandparents and great grandparents where you bought a house and you stayed there for 50 years. You know, today we're buying and selling every 8-10 years. That's a lot. That's all. Y'all are crazy. I hate moving. Why are we trying to move every 8 years? You know, I just did it 3 years and 3 years ago, and I'm not really calling this my forever home, but I'm calling it the next step to the retirement home. So I plan on being here for a while because moving sucks. Yeah, Cody.
So I had a family member learn the hard way with a construction loan this past week that they have to get approved before they start
Yes.
even building. Is that because the bank has to approve every little bit of?
Every little bit, because that's what you're paying. That's what they're paying for, is the construction. So I hate to hear that. I mean, like I said, you're standing on dirt with a dream, a glimmer in your eye, and a blueprint.
Yeah.
Saying, give me money. Please give me money for my dream. And the lender's going, what do y'all think about the interest rate situation for a construction loan? Is it high? It can get high. Y'all are crying about 7% for resale. New construction loans can get, because it's risky. Again, you guys, when you hear the word loan, think of through the eyes of the lender. And the more risky the situation to the lender, the more hoops and hurdles, the more rates, the more premium, the more the borrower is going to have to do if you want the loan. I mean, it's pretty much that simple. You don't have to do anything. You just got to buy the house cash. If you can't do that, then we have to work with the lenders. So when we talk about the different loan types and how we pay the lenders back, no matter how many loans you have, another thing, and we've seen this a couple times now, is that mortgage priority. So our lien priority, liens are paid in the order in which they're recorded, except for the mechanics lien that's paid in the order in which the work began. When you buy a home, the last act of the buying a home process is for the attorney to record the buyer's brand new deed. Then and only then is it a done deal. So the attorney records the buyer's new deed. And in the very next breath, the attorney will record the lender's deed of trust. A lot of times, buyers, before you even get your key, you already have a lien on your brand new home. Doesn't that make sense though? The lender that originated you the loan, that gave you this 97.5.5% for you to go buy a house, how do they protect their interest? They get that deed of trust on record as soon as they possibly can. So the owner can't sell it out from underneath them. By putting it on record, they're letting the whole world know, hey, I am owed money on this property. So priority is going to be in the order it's recorded. Your deed of trust, unless there's something that wasn't paid off from the previous owner, your deed of trust will be first. So we pay superior liens, you pay your deed of trust, and then everything after that in the order in which it was recorded. That deed of trust that you use to buy the house, to originate the loan and to buy the home, that first mortgage loan you have on it when you bought is considered your senior mortgage. Your senior mortgage is the top priority. It is the loan that you took on the property so you could purchase it. Any other mortgage after that is considered your junior mortgage. Did you get a second loan on the property? Did you get an open-ended mortgage or a line of credit, a line of equity? Those are considered your junior mortgages. Question comes in. Remember, your superior liens are always paid first. Always. So your superior liens are unpaid property taxes and government special assessments. After that, all other liens are paid in the order in which they're recorded, except for the mechanic's lien that's paid in the order in which the work began. So you buy your home today. Y'all want to go buy a house today? Let's buy a house today. No? All right, we don't have to. Let's pretend that we're going to buy a house today. So we buy a house today. Your senior mortgage kicks in because your senior mortgage showed up today to buy a house, for you to buy a house. So your senior mortgage is going to be recorded. They record your deed, and then in the very next breath, they record the deed of trust, and then they call you and say, come get your keys. So let's fast forward. Let's say you've been in this home for, I don't care, 10 years, 15 years, and something comes up in life and you need to get another loan on your property. So now it is October 19th. What year is it? 23, 24, 25, 26, 27, 28, 29. Let's say it's October 29th, 2029. Something comes up. You need to get a junior mortgage. You need to get another mortgage, or you need to borrow against your home. Everybody good with me so far? Senior mortgage is going to get paid first because it was recorded first. Junior mortgage will get paid later, second, because it was recorded later. With the idea of a subordination agreement is the act of placing yourself in a lower ranking. Where we see in lender terms, in lender speak, where we see subordination agreements is when the borrower wants to refinance their senior mortgage. To refinance your senior mortgage means you're applying for a new interest rate. You're applying for new terms. You are applying to take your existing loan and somehow consolidate it, lower your payments, whatever, but you're applying for a new loan. And whenever your new loan, that refinance, gets approved, they're going to have to re-record it. So if you request the finance after your mortgage loan, the refinance after your mortgage loan, that would have your your senior loan getting paid after your junior because you refinance. You adjusted that lien priority. This is where the subordination agreement is going to kick in. The senior loan will not agree to refinance unless the junior loan agrees to subordinate. And if the junior loan subordinates, that means no matter lien priority, the junior loan agrees to get paid underneath the senior loan. They agree to place themselves in that lower ranking. So if you have multiple loans out there and you want to refinance that senior loan, they won't do it unless the junior loan or loans agree to subordinate. And what they're agreeing to is to be paid after that refinanced senior loan. Questions on this? Is the package loan the same as a portfolio loan? That's a good question. I'm not exactly sure what the portfolio loan would do. But the package loan, what we do need to know, just combines that real property and personal property. So continuing on unit 15, pretty much the rest of this unit is kind of the in practice, just the things that we're going to encounter day to day. Even though I'm not a lender, I'm still working with the buyers. The buyers are getting a loan to get the property. So I'm still working in this day to day, communicating directly with the lenders. So some practices, some lending practices. We're going to define the loan application when we get to unit 21. But for right now, let's understand that the loan application consists of 3 different parts. The lender has to collect certain information from the borrower. What's the borrower's employment? What's their income? What's their debt? What are their outstanding financial obligations? The lender needs to collect information about the property. So we need the address, legal description. There's only so far in the loan approval process we can go until we find the one. I can only go so far until we have a bona fide contract in our hand. The lender has to have a property to start the loan application. So we could get the borrower pre-approved. We could even get the borrower pre-qualified. But that's as far as we can go until we can get a contract to show the lender the property. And then the third piece of loan application is going to be information about the loan. How long, how much, interest rate, that kind of good stuff. I think the best thing that we do, or we should be doing as buyer's agents, is helping our buyers better understand this loan application process. When we start the loan application process, once the lender has these 3 pieces of information and they start the loan application process, the lender, almost think of the beginning of the loan application process, the lender takes a snapshot or a picture of the borrower's credit. This is what their income looks like today. This is what their debit looks like today. This is their credit, chica, today. Now, fast forward through the contract to closing process, we are days away from settlement, and the lender is going to take another snapshot of the borrower's credit. Those 2 snapshots from the beginning of the loan application process to the end of the loan application process need to match. They need to be very similar. And I'm not telling you your buyers can't go out for dinner tonight. Of course they can. What we're saying is your buyers can't run out, open new accounts. Your buyers can't go out and open a rooms to go account to buy furniture for the new house that they don't own yet. That's going to harm their credit. And guess what, you guys? They may not have a house to put all that new furniture in. I tell you what comes up often. It shocks me how often this comes up. We go under contract and the buyer runs out and buys a brand new car for the new garage. Guess what? They no longer have the garage to put that brand new car in. Not that they can't afford it. I don't know if they can or not. There's a good chance that they can't. But guess what? What matters is that their snapshots from the beginning of the process to the end of the process don't match. And that's a conversation we need to have. We need to have with our borrowers, in addition to the lenders having that conversation with their borrowers as well, because this happens often. So we need to look at the buyers and say, don't buy the car, don't buy the furniture, don't buy anything major on credit. Don't open accounts, don't close accounts. Don't touch your credit until your new deed is recorded. Once that new deed is recorded, now you can go to the car dealership. Now you can go to Rooms to Go. I don't care where you go, but don't do it beforehand. And honestly, you guys, as an agent working with buyers, yes, this is the lender's responsibility. But as an agent working with buyers, help yourself by having a conversation with the buyers not to mess with their credit until after they buy the home. This could kill a deal faster than anything. Yeah. Hey, Travis.
I just had a question about that because I thought that that was the case too, but it was weird. My sister, I just want to know if it's different between the type of loans. My sister, they had a VA loan, and it was for a new. They built the house from. They bought the land, built the house from ground up, so they got approved for the whole loan, like you said earlier.
Mhm.
My sister got in a wreck, and
Mhm.
and she had to get a new car. And I was thinking, like, just from what I had heard purchasing homes before, don't open up new credit, it'll mess up the loan. Well, it didn't. So I didn't know, like, she went and got a new car, and there was no issues with her. So I didn't know, like, was there differences in those type of loans, or
Without being a lender and without knowing the situation, what that tells me is she had the credit. So they may had to run her numbers because now they got to run it with a car in her purchase. But if they rerun the numbers and it still shakes out to their favor, they'll still give you loan approval.
oh, so they
But
can
you may
okay.
you may have a delay because they got to rerun the numbers. And that's the point. That's what we need to. We're trying not to delay closing.
Okay.
You know what I'm saying? So, and I don't know if hers was or not. It was new construction, so it was probably a good chance that it was. So that may not have come up because they were building the house. You know what I'm saying?
Okay.
And then, so it's not a killer every time. I mean, if you
Okay.
got the money, if you got the credit, if you can still make the payments, then the lender's like open as many accounts. But it will slow things down a
Okay.
little bit.
All right.
And at the end, they may say, well, you bought that new car, that Jag, which is going to look great in the garage, but now you're maxed out because your loan approval is only for X amount. So maybe your sister was buying way under her approval. You know what I'm
Okay.
saying? And then she
Okay.
had some wiggle room in between.
All
I
right.
don't want us going in that conversation with future buyers saying, oh, you'll be fine, buy a
Right.
car, don't worry about it. Because your sister, to me, sounds like a unique situation.
All right. Cool.
I hear more stories of deals falling apart than not over this. So again, you guys, this is one place that we can step in and help the lender, that helps your buyer, and ultimately also helps you. So have these conversations. Yeah, I had buyers once, we got under contract, and then what was it? It was a college, it was a student loan debt consolidation. He submitted an application for a student loan debt consolidation. If he got approved, that student loan payment would be smaller, and that's better for the lender, right? But the problem is he started the application. The lender wouldn't approve the loan until we knew if he was going to get approved for that debt consolidation or not. And that closing was, I said, I'm sorry, you did what? He's like, oh yeah, I called Student Loan Center and we started the application today. And I was like, is that bad? And I was like, well, smile, always smile. It's not good, you know? So our closing was delayed a couple weeks because the lender wouldn't approve the loan amount until we knew the outcome of the debt consolidation, because it changed that snapshot. And that's what I mean. If you don't want to throw up flags, if you don't want to throw up issues, the snapshot of your debt to income or the borrower's debt to income needs to be similar now than what it is as we get closer to closing, from the beginning of the loan application process to the end of the loan application process. I even went so far once. I had friends of mine that I had them under contract and they were at the beach for the week, which is fine. Like I said, you can take a vacation, just don't go down there and go nuts with the credit card, right? So they're at the beach and he called me. He said, Julie, we found furniture. Is it okay if we buy it? I said, no. He's like, what if we do some of it with cash? I said, no. I don't know another way to say this. And he kept at it. And I said, you need to call the lender. No, I don't want to do that. I'm not going to tell you it's not going to affect your loan because I don't know. But what I do know is it could slow us down. It could prevent you from getting a loan. And that's what we need to make them aware of. Don't touch your credit during this loan application process. We got to get final approval. You got to record the due deed, and then you can go nuts with your credit. So let's go ahead. Oops, and take our break. We come back, we keep going in unit 15. Got some thumbs up. Good. I do too. I like the pumpkin. They have Thanksgiving themed ones too. So we have that to look forward to after after Halloween. You got to have fun, you guys. That's one thing I've learned about life. You got to make time for fun, even if it's a silly timer. All right. So what can you do? We can have these conversations with our buyers to make sure that their credit stays the same. Again, if they're well under their approved amount, or if they have a good credit, then they might be able to buy the furniture of the car. But if not, then they won't be able to buy the home to put in for the furniture of the car. One thing that a lender will always look at first and very early, when a borrower calls to get a mortgage loan, one of the first things that the lender will look at is going to be a credit score. Now, your credit score isn't the only determination. It's one of the things that the lender looks at. So we all have a credit score. Those credit scores range from 300 to 850. The higher your score, the lower risk you are to the lender. If you have a credit score in the high 700s, maybe your credit score is 800. What you tell the lender with a credit score of 800 is you pay your bills on time every time. If you have a credit score of like 400, you tell the lender you don't pay your bills, maybe, sometimes, only when you want to. So the higher the score, the less risky you are to the lender. Again, this is not all they look at, but this is something they look at early. All lenders are different, you guys. And some of them may say, if your credit score is under 550 or 600, whatever, they're all different. So they may have a minimum. And if they say, if your credit score is under this, there's no point in us proceeding. A good lender will help a borrower get their credit score up. It takes time. Absolutely. It takes time to build good credit. But a good lender will work with this borrower and help them get that credit score up so they can buy a house somewhere down the road. And if that lender is the one that helped them get their score up, they got a good chance of the borrower contacting them when they are ready to buy. By the way, is that buyer's agent? Why don't you stay in touch? Or the person that has been talking to that buyer, maybe they're not even your agent yet, but the person that's been talking to that buyer, why don't you stay in touch with them too? Because in a couple years from now, when they are ready to buy, who do we want them to call? You. So send them a holiday card, call them every once in a while and ask them how little Susie's doing in school. Stay in front of them. So when they are ready to buy, they'll call you. Sometimes we have to incubate buyers. Sometimes buyers want to buy, but they can't right now. So we stay in touch. So when they are ready to buy, they call you. That's what we want, right? So credit score is one thing we look at, or the lender looks at. Another thing the lender looks at is your credit history. The lender's going to go back, or specifically their underwriting department. We'll talk about underwriting in just a second. They're going to look at 2 years of your detailed history. They're going to look at 7 years of your repayment history. So they're basically looking at the last 2 to 7 years, your credit for the last 2 to 7 years. If the applicant can show a reason why their credit history is not great or not been consistent over the last 2 years, the underwriter may still approve it. Examples of exceptions might be like death of a spouse, for example. Borrowers that are going for FHA and VA loans, if your credit score is low, if you have a history of making late payments, that borrower is probably going to be ineligible for an FHA or VA loan. Maybe the lender can get you in conventional, USDA, whatever. But again, with the government involved, with FHA and VA loans, if you have this history, if you show this pattern of being late, then they may not approve. So what the lender is going to do first is kind of this soft pull to get this information to see if it's worth going on, to see if it's worth discussing, just from them kind of crunching the numbers. Again, we're going to talk more about that process a little bit more in just a second. Yeah, Phil.
Yeah, I was just gonna say quickly, 9 years ago, when we moved up from Florida to the Raleigh area, they put us up in corporate housing. It took 7 months. And we owned our cars, and the house, the water and gas, we put in my name. Oh my God, and to go and buy a house, because my wife didn't have any credit payments for 7 months, even though over 800 scores and great salaries. It was a nightmare with Bank
Yep.
of America. You had to go through all this extra stuff. My wife was crying.
Yep.
Yeah, so
Yep.
you got to be careful. So
You got to have a history, right? You got to have some
right.
kind of history. So to Phil's point, if all the bills are in your spouse's name, at the minimum, go get yourself a credit card and put your gas on it and pay that off
Right.
every month, right? Go put
Yep.
your groceries on it and pay that off every month, because then that's showing that you are capable of getting debt and, more importantly, paying it off. That's what the lender needs to see. Y'all want to hear something ironic? Do we like irony? As a real estate agent, I'm not always the best candidate to get a mortgage loan. Ain't that something? I didn't say I couldn't get one, but I'm not the best candidate because my income isn't consistent. I don't get paid every 2 weeks. Remember, when I get paid, when it closes, I may have 3 closings this month and then not have another closing until December. So I have income, but I don't have consistent income. So as an agent, ain't that something? As an agent, I may have to jump through more hoops and hurdles, any independent contractor, just to show that history. And as an independent contractor, they may want to go back more than 2 years to see my income, not just the consistency of it. That's out the window. Phil, when we bought our house 3 years ago, I mean, they pretty much just looked at my husband because he gets paid every 2 weeks. You know, that's a perk. But you guys get it, right? We got to be able to see that history, that consistency. They're looking for patterns, and that's what they're studying with your credit history. At some point in the transaction, the lender will want to lock in the interest rate. When we see rate, for the most part, we're referring to interest rate. So at some point during the contract to closing process, the loan approval process, I should say, the lender is going to lock in the interest rate. And once it's locked in, that is what it is for the life of the loan. So if we lock you in at 4.5 today, and it goes up to 5% tomorrow, you're already locked in at 4.5%. But guess what the other side of that is? If we lock you in at 4.5 today and it goes to 4 tomorrow, you're locked in at 4.5%. Interest rates fluctuate daily. Don't tell your buyers, don't wait until tomorrow to lock it in. Wait till tomorrow, wait till tomorrow, wait till tomorrow. Eventually you're going to get close and you're not going to be able, you may run out of time. They may have to lock you in. So again, have these conversations with the lender about when is the best time to lock in your interest rate. And tell your borrower, I need to say, tell your borrower to have these conversations with the lenders. All right, so let's take our lender hat off just for a second. Don't throw it too far off to the side, but just take lender hat off for a second, and let's put our broker hat temporarily back on. So let's talk about what this all means to us as agents. As the broker, we need to have a basic understanding of how lenders decide, of the approval process. Again, I'm not in lender school. You need to stay in your lane. However, we need to have this basic understanding. When you first meet a buyer, of course, one of the first things we're going to ask is, are you working with an agent? If they say no, then we're going to do our working with real estate agent disclosure. See if we want to do oral buyer agency or written buyer agency. Once we hash out all of that, the next thing you're going to want to do is have your buyer talk to a lender to get a pre-approval or a pre-qualification letter. Do not take people out and show them properties without them first talking to a lender. How do you know what they can afford? How do they know what they can afford? Save yourself the time, the gas, the energy, the money, the wear and tear on your tires and your car. You guys with me? Wouldn't that be awful to work with a buyer for months showing them property and then find out they can't afford the homes you've been showing them. There's a common misconception out there that what I pay in rent will equate to my mortgage payment. And that is the furthest thing from the truth. What you pay the lender and what you pay in rent are two different things. They're two different formulas, two different calculations. It's not the same thing. So your buyer's going to look at you and they're going to say, oh yeah, well, this is my rent, so this is how much house I can afford. No, guys, we need to get them talking to a lender, and specifically, we should encourage them to talk to 2 or 3. As mentioned, the lender initially will do a soft pull on their credit. A soft pull on their credit means it's only going to ting once. Even if you have 5 lenders do the soft pull, it's only going to ting once. So encouraging them to shop around is not going to hurt their credit. Now, once we get into the loan application piece of it, then they do the hard pull, and that's when they take the hit. But having them shop around, that's a common concern I get from buyers. If I talk to 3 lenders, they're going to do 3 different tings on my credit. It's a soft pull. Let's see. During COVID, you had to get a pre-approval letter. That was before looking at any home. That was before COVID. Yeah, absolutely. That's been since the housing market crash, since we came out of that. Anybody buy a house 20 years ago? Or anybody know somebody that bought a house 20 years ago? Things were different 20 years ago. 20 years ago, you found the property and then you talked to the lender. Today, we got to talk to the lender before we look at the property. Again, you're saving yourselves time. You're saving your buyers time. Don't let them tell you what they can afford. They don't know until they talk to the lender. So we talk to a lender, and the lender is going to issue a pre-qualification or a pre-approval. So let's talk about what those differences are. First off, neither one of them are final approval. It's a pre-qualification. It's a pre-approval letter. The approval process doesn't start until we go under contract. So we're just getting preliminary. So I have a ballpark idea of the properties, the price points of the properties that I can show them or should show them. The pre-qualification is the first step. And with the pre-qualification lender, the borrower calls the lender and says, this is my debt and this is my income. And based on what the borrower tells the lender originates a pre-qualification. Doesn't seem real strong, does it? Do people lie sometimes about their debt and income, specifically their income? It's funny how people make more money than what they make on paper. So can people fabricate those numbers? Absolutely. So the pre-qualification means the lender's, based on what you said, the lender's crunched the numbers. A pre-approval is taking that a step further, and now the lender is verifying the numbers. So a pre-approval tends to be a little bit better, a little bit more secure than a pre-qualification. What are you going to get from the lender? It depends on the lender. They're all different. Some will do the pre-qualification, then we get the property, they'll proceed. Some will do a pre-approval. It all depends on the lender. But I don't want you guys, in practice, real world, I don't want you guys spending your time and your energy and your money out showing properties for weeks or months just to find out the buyer couldn't afford that price point. If you don't hear me now, you will if it happens. So don't let yourself get in that situation. Tell the buyer, I got to protect both of us by making sure what you can afford, what we're looking at is what you can afford. Cody, to your point, before looking at any home, there are some sellers that will say pre-qualification or pre-approval required before I allow you to see my home. Because for sellers, we got to ask you to leave, right? We got to get you out of the house for an hour for the showing. And some sellers might say, I don't want to go unless we have a serious buyer. I can't blame them.
And maybe that's what I'm getting confused with, because we bought a house in COVID. And that was the time when people didn't want just strangers walking through their homes. So maybe it was just the pre-qualification that you needed before you could even look at a home.
Yep. Like I said, we've been doing that. That's long before COVID. COVID got stricter because you're right. Sellers didn't want a lot of people in their home touching stuff and breathing on everything, so that was a hard time to buy. It was a hard time to sell. You know, it was a hard time in general. But yeah, for you guys, like I said, we've been saying for 15 years now, don't show them anything until you know that a lender says, I've talked to them. Here's a pre-qualification, pre-approval. Once we get through that loan application and the lender, we got a contract, we have information on the borrower, we have information on the contract. Then the lender, when we go under contract, the lender's like gathering information, they're getting everything they need. They're going to order the appraisal. They're going to ask the buyer for, you know, check stubs and debts and receipts and all their paperwork. The borrower's got to send everything in that the lender requests. And once the lender collects what they need, they will send the loan through the first round of underwriting. Underwriting is where they scrutinize it and critique it. There aren't any rocks left unturned in underwriting. So if the borrower didn't submit debt or the borrower didn't submit income, underwriting is going to find it. They are doing the deep dive in the credit. And they're looking for some characteristics to see if we can, or the lender can give loan approval. It's not uncommon for the loan to come out of underwriting the first time and the lender requesting more information. So we send it through underwriting. What we get out of underwriting is a pretty good idea. And usually the lender can say, everything's looking good. All we need are these 3 more pieces of information. If you submit these, then we should be good to go. You submit those 3 pieces of information, they send it through underwriting again. And usually when it comes out of underwriting the second time, we have loan approval or loan denial. This is where it gets tricky as buyer's agents, you guys. In all my years, I've only known one borrower to get loan approval while we were still in due diligence. Mostly we get final loan approval days before settlement. We will talk a little bit more about that when we get into 21. So we're in due diligence. The best I can do during due diligence is work to get this thing through underwriting the first time. So we know in due diligence, the lender's pretty good idea. This is either looking good or it's looking a little shaky. But based on the lender's pretty good idea, the borrower has a decision to make. Do I want to proceed with or terminate this transaction while we're still in due diligence? Like I said, I've only known one buyer to get approval while in due diligence. So as a buyer's agent, we've talked before about how long we need for due diligence. And the length often comes from the lender. How long does the lender need? What's the lender's time frame? Again, I want this thing to go through the first round of underwriting at least. Comes out of underwriting the second time, we usually have information. Again, one of the big things that we can do as agents in this process is explain to our buyers the importance of communicating with the lender. If the lender says, I need these 3 documents, the buyer needs to get it to them. The lender cannot proceed with their process until they collect what they're asking for. Would it surprise you guys if I told you that there have been buyers that have delayed their own closing because they're not communicating with the lender? They're not getting the lender what they need. So one thing that we can do is help keep that communication. So buyer's agents, we go under contract. Yay, do your happy little mini dance. The first thing I need you to do as a buyer's agent when you go under contract is to get this contract to the lender. The lender's got to start their thing. And then I need you to look at your buyers or call your buyers and say, congratulations, you're under contract. The lender started their thing. The lender will be in touch with you to gather the rest of the information that they need to send it to underwriting. Mr. and Mrs. Buyer, I need you to be in touch with and communicate with the lender. If they need something, if they're asking for something, it's for a reason, just get it to them. I tell my buyers to call the lender back before they call me back. So make sure we're helping this process move forward by explaining to the buyers the importance of communicating with the lender, understanding they can't proceed until they get what they're requesting from the borrower.
Yeah, so as you're aware, we're in the middle of buying a home and we do the pre-approval and all that, and it expires every 90 days and then we redo it. So as you're aware through my introduction, I decided to leave the corporate workforce. So I'm not working. The first thing I did was called Bank of America and said, I left my job. Fortunately, we're in a position it didn't matter, but I wanted them to be aware, underwriting. I'm not working. So just FYI,
Yep,
that
because
income's
they'll find
gone.
it. They'll find it.
Right. So I told them the minute I left my job, that's the first thing I did. The first
Good.
hour was call them.
Because you're keeping that ball moving, you're keeping those wheels going. And guys, hear me when I say buying a house, contract to closing, loan process, it's a process. It's a process. It takes time and it takes steps. And this is a huge part of that process. I always think of underwriting because if you ever call a lender and say, hey, it's Julie with my buyers on 123 Main Street. I'm just calling to check in and see how the loan process is going. And the lender's going to say it's in underwriting. And for the longest time when I got in sales, I didn't know what that meant. I was like, underwriting to me was this big black hole somewhere that just didn't exist. I was like, where is underwriting? How can I get to underwriting? Is there something I can do about underwriting? Some lenders have their own in-house underwriters. Some, send them off to bigger underwriters like New York, New Jersey, that kind of thing. Again, all lenders are different, but they all have underwriters that are processing. And when I say taking a deep dive in the buyer's loans, I mean, they're taking a deep dive. We're trying to prevent another housing market crash. Remember, prior housing market crash, it was super easy to get a loan. You know what happens when it's super easy to get a loan? We have things like the housing market crash. So now we got to make it harder. There's got to be more jumps. They've got to verify and look, and that's what underwriting is about. Also, with loan approval, one thing that the lender will look at are some qualifying ratios. Each loan type has a different qualifying ratio. We are actually going to talk about what the numbers mean for the conventional ratios. This is the math we're going to see at the end of Unit 15. So we will talk about that 28 and 36% when we get there. I don't know that these are hard numbers that you need to know because they do change. They can fluctuate. These have been the numbers for several years now. But as things are adjusting, as the market is stabilizing, who knows what kind of change to come. So I won't spend your time memorizing these. But know that the lender has to look at a couple different things for conventional FHA loans, and they look at these qualifying ratios. Again, this is the math that we're going to see at the end of this unit, so we'll talk more about that then. So on Tuesday, I introduced you guys to a lender law referred to as TRID. And TRID was the acronym of all acronyms. And the T in TRID stands for TILA. TILA is the Truth in Lending Act. So we need to talk about the T in TRID, TILA, and a couple things that does and what it means to us. We're going to talk about RESPA, which is the R in TRID, when we get to Unit 21. So just focusing on TILA, the Truth in Lending Act. When you guys see TILA, what I really want you to see is that word lending, because TILA tells the consumer, how much is it going to cost me to get this loan? We're educating the consumer. We're helping them understand their numbers. TILA is referred to as Regulation Z. You need to know, put it on a flashcard, that TILA is also known as Regulation Z. Keep in mind that TRID is a lender law. So TRID only applies when a lender's involved. If this is a cash buyer, lender's not around, thus TRID doesn't apply. So we usually only have lender laws, or we only have laws in place like these that are effective if lenders are around. If it's a cash buyer, the general rule of thumb is there are no rules. We don't have those scrutinies, those restrictions of the lenders. And one thing in particular that TILA does, other than tell the consumer the cost to get the credit, another thing in particular that it does is it regulates how lenders advertise their loans. They have advertising restrictions to make sure that lenders aren't putting false information or misleading information out to the consumer. Remember, TRID is all about consumer protection, not lender protection, not broker protection. TRID is about consumer protection. So making sure that when the lender is advertising the terms of a loan, if they're promoting or advertising or disclosing in any way, making sure that they're in compliance with TILA's advertising regulations. So TILA says that we need to, or the lender needs to, inform the consumer of these chief disclosures. So when you apply for a loan, there's certain information that you should get. Specifically, the chief disclosures are broken down into some information that the consumer sees after their loan application on their loan estimate. The loan estimate comes out after the loan application. Again, we will see more of this in Unit 21. And under TILA, there's certain chief disclosures that the lender has to put on the loan estimate for the borrower after the loan application. The APR is the annual percentage rate. The APR is a culmination of all of the fees charged for a loan. The APR includes the interest rate. So the interest rate is just one piece of the loan. The APR is the entire annual percentage rate. Another chief disclosure that must appear on the loan estimate are any financing charges associated with the loan. The loan estimate needs the total number and amounts of payments. If it's a 30-year loan, we're going to make that payment 12 times a year. 30 times 12 means the number is going to be 360. And how much? Remember, your principal and interest, your debt service stays the same for the life of the loan. So what's that amount of the payment? And then another chief disclosure on the loan estimate will be that total amount financed. We'll look at a sample loan estimate when we get to Unit 21. We'll talk a little bit more about that. Again, more about the loan application and that process. But one thing that TILA, one restriction that TILA puts on the lenders is when you give the loan estimate to the borrower, they must have these chief disclosures. They must have this information. As mentioned, the other piece, the other lender restriction is on their advertising regulations. And specifically, TILA tells the lender that you can't advertise trigger terms. Now, we're going to look at some examples in just a second. But a trigger term is a specific number about the loan. Understand this, you guys. Loans, specifically mortgage loans, are not a one-size-fits-all product. And what we're trying to avoid here, what TILA is trying to avoid here with advertising, is the lender giving a specific number about the loan, telling consumers that you qualify for this specific number. For example, can we hear the difference between low down payment versus $5,000 down? 5,000 is pretty specific, right? Is low down payment specific? No. So the lender can advertise low down payment and not hit a trigger term. They cannot say $5,000 down because now they've set a specific number. Loans are not a one size fits all. And to advertise specific numbers, the assumption is that they are. I don't know you guys all that well, but I think it's safe to say that every single one of us on this call has a different credit score. We all have a different credit history. We have different income. We have different debt. We all come to this loan application different. If we really wanted to have some fun this afternoon, y'all want to have a good time this afternoon? We could all hang up at 1 o'clock, get off of Zoom, we could all call the same lender and apply for a loan for the same property. Y'all want to do that? No, we're not going to. But if we did, I promise you, all 40 of us will come back with different terms because we'll all have different down payments, income, debt. Is this making sense? We'll come to have different interest rates. Our payment amounts will be different because loans are not a one size fits all. So because it's all different, the Artilla says, don't advertise using specific numbers. Speak generically. If the lender does hit a specific number in the ad, then they need to disclose all of the terms. So you can't just say $5,000 down. Once you say $5,000 down, then you have to say, this is the amount you're financing, this is your interest rate, this will be your payment every month, and for this term, this many of years. If you're going to advertise a specific number, then you're advertising a one size fits all loan. So if a trigger term is hit and a specific number about the loan is mentioned, also in the ad, the lender will have to have the amount of down payment, the amount of any payment, number of payments, repayment period, and the dollar amount of the finance charge. So once you've hit one number, you've got to disclose them all. Or more importantly, the lender has to disclose them all. So once a trigger term is hit, it's just a specific number about the loan. Once that's hit, per TILA, the lender needs to advertise all of the numbers about the loan. So if we were to look at a couple examples, do we see the difference in $600 monthly payment versus low monthly payment? Which one's the trigger term?
600.
The 600. Low debt monthly payment, what's low to you may not be low to me. Does that make sense? Do we see the difference in zero down versus low down payment? Again, what's the specific number? The zero. Lenders need to be generic in their advertising. They can't give some kind of implication that we can all get a $600 monthly payment with zero down. It doesn't work that way. And please hear me when I say a specific number about the loan. About the loan is referring to the down payment, the interest rate, the number of payments, the amount of payments. Is the list price of the property about the loan, the sales price, what we're asking for it? Does that have anything to do with the loan whatsoever? No. What about HOA dues? Is that about the loan? Nah, that's about the HOA. I bring this up because I know you guys, and you're reading a test question about TILA and you see a number and you go, specific number, trigger term. Stop and ask yourself, what's that number about? Is it about the loan or not? If it's the list price or the HOA dues, it's not about the loan. We haven't hit a trigger term because it's only numbers about the loan. Do I have everybody? This is where they like to trick you. So we have those trigger terms. And again, same thing we just said. Once a trigger term is hit in the ad, in the same ad, then the lender needs to disclose it all. If they choose to go off the generic, they're making it a one size fits all. Again, this is all about educating, protecting the consumer, and the best way we can protect the consumer is to educate the consumer. So for the lenders, any lender that may violate TILA, gee, Julie, what's the big idea? Well, for lenders, penalties, lenders that violate TILA, specifically advertising, any violation of TILA, and that includes advertising. Let's see. Lenders face penalties. They could be facing $10,000 per day You heard me right. $10,000 per day. There could be other fines. They may even get to go to the big house with the little windows. There may be possible prison time involved as well. So if this is a lender law, why are we talking about this? Well, we as brokers work closely with lenders. Often we are advertising with lenders. Lenders are advertising with us. Often we are working together to sell this home. Let's say, for example, you get a really nice listing. What's your price point? Make up your price point. What do you want? 850,000? Sure. So we get a listing that's $850,000 and it's nice. Oh, it's nice. It's well kept. It's bright and shiny. It looks great. And you decide that you want to do a broker open. So you want to invite all the fellow real estate agents locally to come ooh and ah over your new listing. Why are you inviting brokers? You want them to see it so they can show it to their buyers, right? You're going to have them help you sell it. So you do a little broker open. Maybe you're going to do it this afternoon, or let's do it next week from 2 to 4 in the afternoon. And you're going to do a wine and cheese charcuterie board wine. Doesn't that sound nice? Go get you a glass of wine and walk around an $850,000 home. Welcome to real estate. That's the fun part of it, right? So you're doing this broker open. And you call your lender buddy and you say, hey, I'm doing a broker open. You want to go in on it with me? And your lender buddy more than likely will say yes, because what a great opportunity for your lender buddy to meet other brokers. It's a win-win for everybody, right? So your lender buddy very well may say, yes, I'll go in on it with you. And as a matter of fact, let me do the flyer to promote it. And so the lender generates the advertising. And the lender also, in addition to their contact information, also puts your name, your picture, your face, and your email address on that flyer as well. And the lender hits a trigger term. You are also advertising that trigger term. Everybody with me? Because your name is on that flyer with the trigger term. You too could face the penalties of $10,000 per day, possible prison time. And please don't think that the North Carolina Real Estate Commission won't get involved, and you may possibly face disciplinary action as well on your license. If you're going to work with that lender buddy that wants to be nice and create the flyer, create the advertising, I would ask to see it before it went out to the public and make sure it didn't hit a trigger term and make sure you didn't put yourself at that risk on that hook. So yes, TILA is a lender law. Yes, this applies to lenders. This also applies to us. Be careful when working with lenders advertising in any way. Make sure your MLS ads don't hit trigger terms. Speak generically when you're advertising terms of a loan. Questions on TILA? A couple other lender laws. There's the Federal Equal Credit Opportunity Act. This is the lender laws, fair housing. This is the lender's fair housing. The lender's fair housing prevents discrimination against color for applicants based on their race, color, religion, national origin, sex, marital status, age, or dependency on public assistance. Our protected classes look a little bit different than the lender's protected classes. We are going to talk about our protected classes when we get to Unit 19. And also in Unit 19, we'll be able to compare our protected classes to the lender's protected classes. So there's two different sets that we need to be aware of. For the lenders, when we say that age is a protected class, that's assuming that the applicant is at least 18 years of age. So we need to have adults applying for mortgages. What the age for lenders is protecting, if a 90-year-old applies for a 30-year loan, I'll let you do that math real quick. They can't be denied of the loan because of the fact that they're 90 years old. Is everybody with me? So if a 90-year-old or whatever, that's who we're protecting here. As long as their debt to income ratio shakes out, then they can't be denied because of their age. If an applicant is not going to get loan approval, the lender has 30 days to inform that applicant writing why they didn't get loan approval. And the reason why they didn't get loan approval better shake down to their debt to income ratio didn't work out. It's nothing to do with their race, color, religion, national origin, sex, marital status, age, or dependency on public assistance. So the lender has a set of protected classes. Ours are similar but different. So we'll look at our protected classes when we get to Unit 19. Another lender law is the Fair Credit Reporting Act. This is what gives you and I the opportunity to check our credit. We can get a credit report free each year. They come from the sources, Equifax, Experian, and TransUnion. The recommendation is you check your credit once a year, just to make sure nothing hits your credit, make sure there's no fraudulent activity. If you do come across some fraudulent activity, you can work. They give you instructions on how to work through it. The recommendation, though, is that if you check it once a year, you know what's up. And if you do go for like a mortgage, if you do apply for a mortgage loan, then you won't be surprised if something comes up. Hackers are out there, you guys. Spammers are out there. They're not just hacking our credits, they're hacking our kids' credits, our dogs' credits. I mean, they're getting crafty and they're trying to hack whatever they can. So check your credit once a year to make sure you don't have some kind of fraudulent charge. Information stays on your credit report for 7 years. Bankruptcies stick with you a little bit longer. But again, we all have the right. If you haven't done it in a while, make yourself a note to do it this afternoon after class. Please don't do it now. Another thing that lenders need to be aware of, that we need to be aware of, is the possibility of loan fraud. Loan fraud is like really, really bad. Loan fraud means you lied on your application. You lied on your application trying to get a loan. So you've made a false representation in order to get money. As brokers, if we hear our buyers talking about something that may shake out to loan fraud, we have a duty to report that to the lender. It's not my job to determine if it's loan fraud or not. But if I hear my buyer saying, you know, oh, we're just going to tell them this, or better scenario. Remember on Tuesday, we had to borrow money from the bank of mom and dad? Actually, mom and dad decided to gift us money. A gift implies what?
Don't have to pay.
You don't have to pay it back, right? Borrow money versus gift money. So mom and dad gift money, they sign something, it's a gift. And then after closing, they say, all right, little Johnny, time to start paying me back. As a broker, if you hear that conversation, we have a duty to report it to the lender. If you see something, say something. It's not my job to determine if it's loan fraud or not, but it is my job to help keep the lender notified. Loan fraud, I said, is really bad. That's not a typo. That is fines up to $1 million. And again, you may go to that big house with the little windows for up to 30 years. If you see something, say something. If you hear something, say something. As we've said numerous times, lenders can set their own everything. Lenders can do what they want to do. They can decide what products they want to offer, the terms, the interest rates, whatever. We do have something called the North Carolina Predatory Lending Act that kind of sets the parameters for the lenders. So within the parameters, the lenders can operate. They can, they put restrictions on high cost loans, what kind of allowable fees and charges, the amounts of allowable fees and charges that the lender can charge. Unfair, deceptive trade practices is exactly how it sounds. Trying to keep everybody safe, consumer protection by prohibiting unfair, deceptive trade practices. And then a big piece is just educating the consumer. So Predatory Lending Act, again, setting the parameters. Within the parameters, the lender can do whatever they want. They're all different. Our buyers need to be encouraged to shop around. And then the last little piece just mentions RESPA. RESPA is the R in TRID. if TILA tells a consumer the cost to obtain the loan, RESPA tells a consumer what it's going to cost you to close. We're going to talk about RESPA a little bit more when we get into Unit 21. What questions do I have? Okay. Let's take 10. When we come back, grab your calculators because we're going to do some math in Unit 15 when we get back. I like them. All right, we're back. Welcome back.
Hey, Julie,
Hey,
I went back and looked at the email and actually once I got to the email, it only showed the breakdown. So I think you had to look at it before you actually, got out of the class marker.
okay, so that's where that's great to know, and that's something I can report to Jane. So thank you for that. Like I said, she's trying to figure it out. So thank you, Kiki. So
So as soon as it gives you your report, just make sure you scroll all the way down and it'll show you
see
everything.
it. Okay. All right. So if you didn't happen to catch that, and I understand because I didn't know that was going to happen. So tomorrow, I will forward each of you your midterm results. I can't tell you what time tomorrow I'll do it, but just be on the lookout for me tomorrow with an email from your midterm results and specifically what you're looking for. It allows you to see the questions that you got wrong. So that'll help you guys. Again, I'm going to be very honest with you guys. What you guys got with the breakdown, how many in each section, how many questions and how many you got right, I think that is far more valuable than the missed question. The only reason we're providing the missed question is because sometimes you guys say it'll help, and I do want to help. So there it is. You will not see the missed questions on your end of course exam. We can't allow that, but we can with the midterm, and we do. So is everybody good with that? Look for an email from me tomorrow. Check your spam. Sometimes I wind up in spam. I don't know why, but sometimes I wind up in spam. So that's on my to-do list. So let me take attendance. And let's see, somebody says, can you see me? No, there we go. Okay. All right, so let's talk about Unit 15 math, which by the way is the rest of our financing math, lender math. So we introduced you to some financing math at the end of Unit 14. So now we're going to look at some more financing math at the end of 15. And before we look here, I want you guys to turn with me in your books. New book people, you're on page 432 and 433. Old book people, you are on 412 and 413. So 432 or 412. And what we're looking at on pages 432 or 412 is called the mortgage factor chart. The mortgage factor chart is also referred to as the rate factor chart. Now, hang on before y'all get excited. You don't have to memorize this thing. Do you know how many times I get asked that? Do we have to memorize this? No. We're mean, but we're not cruel. Okay. You don't need to memorize this. However, we need to know how this thing works. Remember Tuesday, we did Unit 14 math, and we were given the debt service. We were given the principal and the interest, and then we amortized that thing monthly, and we broke it down, and then we looked at interest over the life of the loan. They gave us that amount. The question is, are they always going to give you the debt service? And the answer is no. If they don't give you the debt service, they're going to give you the information that you need to find it. And finding the debt service starts with the mortgage factor chart on 432 and 412. So just a couple things of what we're looking at here before we look at our formula. You first look at that first left-hand column and it says rate. That's your interest rate. Please write that around the word rate. This is the quoted interest rate. And then each column after that is the term of the loan. So are you applying for a 10-year loan, 15, 20, 25, or a 30-year loan? Based on the interest rate and the term of the loan, the lender uses this chart to find the mortgage factor. And the mortgage factor is a piece that we need to find the debt service. I have heard students go to the testing center for their state exam. I have heard students tell me that this thing is like a big chart on the wall. And when they got to this question on their state exam, they had to look at the chart and find the mortgage factor. So again, before we look at the formula, let's make sure we're good with the chart. You guys set your chats to private. And tell me in a private chat, I need to hear from everybody. Tell me in a private chat, if you're quoted a 6.5% interest rate for 30 years, 6.5% for 30 years, I want to know in a private chat, what is your mortgage factor? So you got a 6.5% interest rate for 30 years. And what we need to know is, what would the mortgage factor be? Step one is finding that rate factor or that mortgage factor. And I need to hear from everybody, please. Is everybody in? So take your finger, point at your book, find 6.5% point. Everybody on it? Now move your finger to the right, straight line, until you get to 30. It's either on page 432 or 412. Depending on if you're a new book person, you can find it on page 432. If you're an old book person, you can find it on page 412. So you find 6.5%, 30 years, move your finger over 30 years, and we're looking at a rate factor of 6.32. We need that information for the formula that we're getting ready to meet. Everybody good? You got to have the interest rate and you got to have the term. So back to the question, will they always give you the monthly debt service? And the answer is no. If they don't give you the monthly debt service, they may give you the rate factor. If they don't give you the rate factor, they provide you with a chart, the interest rate, and the term, so you can find the rate factor. Everybody good so far? Okay. So what do we do with that rate factor? Well, we get to use it in a formula. To find your monthly debt service, you take the loan amount, which the problem does have to tell you. What is the loan amount this borrower is applying for? Times it by the rate factor. Again, either they will give you 6.32 or they will make the chart available, give you the interest rate and the term, and let you find 6.32. So you take the loan amount times the rate factor and divide it by 1,000. This is a formula that we need to know. I recommend putting all formulas on a flashcard or putting all formulas on a piece of paper that you entitled formulas. If you don't know the formula to this one, you guys, you might as well skip it. Put down C and move on. I'm not trying to be mean here. I'm trying to be very honest. Knowing the formula is 80% of the battle. And if you don't know how to solve monthly principal and interest because you don't know the formula, don't spend all of your test time on this problem. Know the formula so you can tackle this faster. Put it on a flashcard. So you find your monthly debt service, you take the loan amount times the rate factor, divided by 1,000. That formula can be found in the verbiage, how to use this chart on page 432 and 412. But I don't think they do a good job of giving you the actual formula. They give you the explanation, but they don't give you the formula. Do we have this jotted down? We got it? We know what comes next, right? We get to do math. All right. So tell me in a private chat, what is the Miller's monthly debt service? About 30 more seconds, and then we'll look at it together. The first thing we do when we see a math problem. Nah, what's the first thing we do when we see any problem? Read and breathe, breathe and read. All equally important, both equally important. Do you guys ever find you do well when you have short labored panic breaths? That doesn't work out too well for us, does it? What do we want? Big, deep breaths in through the nose, out through the mouth. Let it go. Okay. The Millers are borrowing $350,000 at 4.5% annual interest for 30 years. Using the mortgage factor chart, it is determined the mortgage factor is 5.07. What will the Millers' monthly debt service be for this loan? We've read the problem. I know what I'm solving for. To solve for this, I have to know the formula. So to solve for my monthly debt service, I take my loan amount times the rate factor, and then we divide the whole thing by 1,000. There's your formula. So the first step, go back to the information and start filling in what you know. I know I got a loan amount of $350,000. This problem both gave you the information that you needed and it gave you the rate factor. Again, usually you're going to see one or the other. If they're going to ask you to find the rate factor, they must provide you with the chart. So I know my rate factor is 5.07. And then the step not in the problem, which is why knowing the formula is so important, is to divide by 1,000. So now we take the loan amount times our rate factor. I get some big number. I divide by 1,000, and I get a monthly debt service or a monthly principal and interest payment. Oh, no, hang on. What did I do? Of 1,000, there it is, $774. There it is, and 50 cents. So you take the loan amount times the rate factor, mortgage factor, rate factor, divide the whole thing by 1,000, and you get a monthly debt service of 1,774. Know the formula. Y'all use the formula while you're learning the formula. I got to wean you off the formula, but in your practice, this is why we give practice. The more you practice using the formula, the easier it is to remember. Questions on how we got our monthly debt service?
So we don't do anything with that 4.5?
No, because the formula uses just the loan amount, the rate factor, and the 1,000.
Okay.
Now, had they not give us the rate factor, then I would need the interest rate and the term to find it. Turn with me real quick. Let's go back in your books to the end of Unit 14. So either 407 or, where's my old book, people? 387. 407 or 387. Those three problems at the end of Unit 14, 28, 29, and 30, you now have the formula you need to solve those three problems. The first thing they're going to want you to do is find your monthly debt service. So now you have that information and you can do those problems at the end of Unit 14. We also got some other practice for you guys in the online learning system, and I will show you that in just a bit. Questions on the mortgage factor or the rate factor? Same thing. The second piece of math in Unit 15, old book people, you do not have this in your book. New book people, you do. Old book people, I have copied this from the new book and put it in the online learning system for you. So old book people, make sure you're looking under the Julie folder and you have this information that we need to do this next piece of math. The next piece of math is going to be math on qualifying our buyers. And we can qualify our buyers by looking at those qualifying ratios. Understand this up front. Qualifying a buyer is the lender's job, not mine. However, I need to have a basic understanding of how this works. Once upon a time ago, all lenders worked Monday through Friday, 9 to 5. So let's say you're a buyer's agent and you have a buyer contact you Friday at 5:30 and want to know if they can go with you to see houses this weekend. And you know your lender's not going to be back in the office until Monday morning at 9. You either risk losing this buyer or you take this opportunity to sit down and crunch some numbers yourself to make sure that they're close so you can show them properties this weekend before the lender gets back in the office on Monday. Now let's fast forward to today. Today, most of our lenders will look at you and say, we work when you work. So most lenders, if you get a buyer at 5:30 on Friday, you got that lender connection, that vendor, that one on speed dial. They may help you Friday at 5:30. They may help you on Sunday afternoon if somebody wants to write up an offer from your open houses. Most lenders today say, I work when you work, but not all. And so it's still important that we have this very basic understanding of qualifying a buyer. In the event we can't get in touch with the lender, I'm trying to protect y'all's time. Again, you can believe what the buyer says, or you can verify and crunch the numbers on your own to save your time. I don't have a pre-approval. I don't have pre-qualification, but I do have a calculator. So I can start, get myself some information. Those two ratios, again, specifically, we're just going to focus on the conventional ratios. Your test more than likely will give you these ratios. I've not heard otherwise. Let me put it that way. With that being said, I would still be familiar with the 2836. So let's talk about what these two ratios do before we pick up our calculator. The first ratio, the 28%, looks at housing expenses only. And housing expenses as defined by the lenders are your PITI. What's your PITI? Principal, interest, taxes, and insurance. Your PITI is what you send to the lender every month for your loan payment, your mortgage payment. Housing expenses also look at HOA dues, if applicable. Housing expenses look at PMI, private mortgage insurance, if applicable. When's it going to be applicable? When you have a conventional loan with the loan to value ratio of 80% or more. So housing expenses consist of PITI, the projected PITI, HOA dues, and PMI, both if applicable. What this 28% means, let's look at pie. And if I pretend, if we say that this entire pie represents the borrower's monthly income, the entire pie represents the borrower's monthly income. How much money does this borrower have coming in each month? And the lender will allow of the entire monthly income, they will allow the borrower to allot 28% of their income to housing expenses. What are housing expenses? PITI, HOA dues, and PMI. Of your income, the lender will allow, they will approve 28% of your income to go towards housing expenses. The other number in the ratio looks at, the 36% looks at the borrower's reoccurring obligations. The lender defines reoccurring obligations as your housing expenses. What did we just say housing expenses were? PITI, HOA dues, and PMI. So we're going to look at your housing expenses plus the borrower's reoccurring debt. What are the bills that you sit down and pay every month? Credit card, medical bills, car loan, student loan, child support, alimony. All that debt that you have that you pay every single month is considered your reoccurring debt. Again, if the pie represents the borrower's monthly income, the lender will allow 36% of your monthly income to go towards your reoccurring obligations. That's what those numbers mean. These are ratios per your income. In order for a borrower to qualify, they must qualify under both ratios. So to get loan approval, our housing expenses need to be less than 28%. Our reoccurring obligations need to be less than 36%. We got to qualify under both 28 and 36%. Questions so far? By the way, why do they cap this off? That might be a question. Why do they cap this off? Well, let's look at this. At this point, you've just paid your housing expenses and you've just paid your reoccurring obligations. Have you gone to the grocery store yet? Have you put gas in your car yet? Have you paid your utility bill or your internet bill? This is all we've done so far is pay housing expenses and reoccurring debt. This is why the lender caps it, because we still have to buy food. We still have to get gas. You want a new pair of jeans this month? They need to make sure that you can allot for that and that you're not spending all your money on the house and not having enough money left over for yourself. We need to set some aside. What if your water heater blows up, right? So we can't allow all of your income to go to your housing expenses and your reoccurring debt. So the lender has to cap it off so you can still do other things with your income. So now that we have a better understanding about what these numbers mean, and we'll see them again in practice, let's look at the formula we're going to use. And good news, we can use a T-bar. And actually, when we're qualifying a buyer, we're going to use two T-bars, one for the 28% and one for the 36%. We got to run them both to make sure that they qualify under both. So your qualifying ratio is either going to be your 28% or your 36%. Again, two T-bars. The number on top is your monthly expenses. Monthly expenses are part of your monthly income. Monthly expenses are referring to housing expenses. What do we say housing expenses were? PITI, HOA, and PMI. We are going to look at solving for all three of these pieces. We're going to, in class together, look at solving for your monthly housing expenses, look at solving for your monthly income, and solving for qualifying ratios. This is a lot. This requires practice. Remember, we're recording right now. So we're going through these together. I got plenty of practice for you guys afterwards for you to take a look at these. If you want to go back and look at the recording, I would make a note in your notes right now that it's about 11:25 a.m. So you know specifically where to find this section. So as long as we all have our T-bar written down, we're going to go through finding the scenarios for all three of these. Is everybody good? Is everybody with me? I see head bobs. I see thumbs ups. I see nothing in some cases. Some sign of acknowledgement out there. Okay, good. Okay, so the first thing we're going to look at is if the problem asks, do the buyers qualify? So Jerry and Shannon are considering purchasing a home. Together, they earn $83,000 per year. Their estimated housing expenses are $1,500 per month. Their monthly recurring debt is $1,100. Would Jerry and Shannon qualify for a conventional loan using the 28-36% ratios? I've read the problem. I see my qualifying ratios, and I may not know anything else except for the fact that I'm dealing with two ratios. Thus, I'm dealing with two T-bars. This question asks us to find their qualifying ratios. So what we're solving for here is the qualifying ratio. And what we need for them to approve is for their housing expenses to be less than 28% and their housing expenses plus recurring debt to be less than 36%. We're making sure that they fall under that 28-36%. The number on the bottom left is their monthly income. Does the problem give me monthly income? Nah, it gives me annual income. We need to know the formula. Do you see how they like to trick you? So when they give me annual income, what do I need to do?
Divide by 12.
Divide by 12. So I got an annual income of 83,000. I divide by 12. And we have monthly income. Is it 83? 83. And we have monthly income of 69.6.67. We'll say, is that what you guys are getting? Something looks funny to me.
That's what I got.
Okay, good. Thank you. Monthly income is the same because Jerry and Shannon are the same borrower. So the monthly income is the same for both T-bars. Everybody with me? Because we're only talking about this borrower. We got to get this borrower approved under both ratios. So we took their annual income, divided by 12 to get their monthly income. Now we got to look at the number on top. So they have an estimated housing expenses are $1,500 per month. And then we have housing expenses plus reoccurring debt of $1,100. So when we add those up, we get their reoccurring obligations under the 36 as $2,600. So the 28% just looks at housing expenses. The 36% looks at housing expenses plus reoccurring debt. Their total reoccurring obligations. Questions so far? Where I got the numbers I got? That fourth line on the T-bar means divide. So on your calculators, you take 1,500, divide it by 6916.67. I get 0.2168, whatever, shakes out to 21.7, I'll say, %. So far, thumbs up or thumbs down. So far, are Jerry and Shannon within their 28% qualifying ratio? Would they qualify under this ratio? And the answer is yes, because they are under the 28%. They got to be under that 28%. So we ran their housing income as part of their monthly income, and we got their ratio of 21.7%, which means so far so good. Before they can get approval, though, they need to be approved under both ratios. So now we do that little exercise again with our other T-bar. Only this time we're going to take our housing expenses divided by our income. And we get 0.37 something 59, which shakes out to 37.6%. More than or less than the allowable 36%. This is more than, are we getting loan approval? No, because in order to qualify, Jerry and Shannon have to qualify under both. So because they didn't qualify under both, they're not going to get loan approval for this loan. It's not over yet. Maybe, okay, obviously it's their reoccurring debt that's not allowing them to get approval, right? Because they approved under housing expenses, but it's their debt that's preventing them from getting this approval. So the obvious solution for Jerry and Shannon is to either make more money or pay off your debt. Easy enough, right? If that's not realistic at this moment, we may want to consider looking at a less expensive home that would have less expensive housing expenses. You see what I'm saying? So just because we don't qualify for this housing expense, this loan, doesn't mean we can't get them in another property. We just need to, or the lender needs to adjust those numbers. So BJ, I saw you had a question. Thank you for your patience.
After you kept on talking, I figured it out.
Oh, good. That was easy. Anybody else? The question is, would Jerry and Shannon qualify? And the answer is no. We need to go back to the drawing board. We need to figure this out. But under these terms, they're not going to qualify for this loan. This is solving for their qualifying ratios. Questions?
Miss Julie, I'm confused. How did you get 37.6? I think I'm overthinking right now.
So when I took 2,600
Uh-huh.
on my calculator and divide it by 69,616.67, what I
Yeah.
actually get on my calculator is a rate of a big long number of like 0.3759. To
Right.
convert a rate to a decimal, to convert a rate to a percent, you just move that decimal over 2 places. So the rate of 0.3759 shakes out to 37.6%. Converting decimals to fractions and rates, percentages to decimals, decimals to percentages. That's all we're doing. Just move that decimal over 2 places. Your test will give you a rate or a percent. They're not going to give you both because I'm saying the exact same thing right there. So they're either going to say 0.3759 or 37.6%. So solving for one X of the T-bar. Questions on this one before we solve for another X? We good? Can I erase? Okay. The next piece that we need to talk about is solving for the maximum allowable housing expenses. Remember, we're running these numbers through twice. So now the question is, what's the maximum housing expenses that a couple can have? And in order to do that, before we look at T-bars, let's just look at what we're understanding. You may want to take a picture now with your phone. You will have the opportunity to write all this down later, I promise. But right now, we just need an understanding of what this is saying, remembering that we've got to run this under 2 different T-bars. So my T-bar now, for these, formula on the left, T-bar on the right. Now we're going to be solving for our monthly expenses. You, of course, have your income, your monthly income. And instead of solving for the ratios, we now know the ratios, and we're going to plug this in. So what we're saying here, to solve for the first one, you take the income times the 28%, and that gives you your X, your maximum housing expenses. The second one looks at the income times 36%. And then once we solve for X, then we're going to deduct the reoccurring fees, the reoccurring obligations, we'll call them, or expenses. So we solve for X by taking the income times 36%, like we always do. And then for the second T-bar, we need to take it a step further and deduct the reoccurring expenses. By deducting the reoccurring expenses, that allows us to just look at housing expenses. So we got to deduct those reoccurring expenses out, times it by 36%. Now we're looking at housing expenses under the 28% ratio and housing expenses under the 36% ratio. They can only qualify under one. And when it comes to qualifying a buyer, I always think of opposite world. When the question is asking you for the maximum payment, you're going to run both of these and you're going to get two answers. Opposite world says if you're asked for the maximum payment, the answer is going to be the lower of the two numbers. We're trying to solve for the maximum amount of housing payment that the lender will allow these borrowers to make. Through the eyes of the lender, the less housing expenses you have, the less risky you are to the lender. So they're going to look at both 28 and 36, and then which one will you get approved on? It'll be the housing expenses that's the lower number, that's less risky to the lender. So formula on the left, whichever's easiest for you. T-bar is on the right. Just know if you're using the T-bar for the 36%, once you solve for the housing expenses, once you solve for X, you need to take it a step further and deduct, subtract those reoccurring expenses. Ready to look at a sample? Look at an example? So let's talk about Brian and Margaret. Brian has an annual income of $35,000. His wife Margaret has an annual income of $38,000. Their reoccurring obligations are $700 per month. What is the maximum payment they can afford using those 28, 36% qualifying ratios? I may not know anything else at this point. When you see qualifying a buyer, just throw down two T-bars. Go ahead and throw them down. We know your qualifying ratios, 28%, 36%. We know we're solving for that number on top. And then I got annual income. I got Brian's annual income and I got Margaret's annual income. So again, we need to add those up to get annual income, total annual income, 73,000. The two of them together, and then we divide by 12 to get their monthly. Same monthly income on both because it's the same borrower. We are all talking about Brian and Margaret right now. So we added up their annual income, divided by 12, and got monthly income. Questions so far on the numbers that we have? So now we look at the first qualifying ratio, which is our 28%, which looks only at housing expenses. So when you take your calculator and you take their income and you multiply the allowing ratio, we can see that their allowable housing expenses under these terms, under this qualifying ratio, is $1,703.33. We took their monthly income times the 28%, and I got housing expenses of $1,703.33. Now we look at our other qualifying ratio. I'm going to start with multiplying. But now I'm using the 36%, which is housing expenses and reoccurring debt. So when I look at that, No, let's just say 99 here. I get total housing expenses and reoccurring debt of $2,199. The lender just cares about housing expenses. So from that total, we need to deduct their reoccurring debt. And when I deduct their reoccurring debt, we're looking at two numbers allowed just for housing expenses.
Hey,
This is our
Jewel.
apples to apples comparison. Yeah.
Sorry, I got 2190, not 2199.
Did I
2000.
round? I
Sorry.
rounded wrong. I rounded wrong. Thank you.
Oh, no problem.
Yeah,
Thank
thank you. 2190. Thank you. So we took our monthly income times 36%. I got housing expenses and reoccurring debt. In order for the lender to do a true apples to apples comparison, we need to take out that reoccurring debt. So now I got housing expenses allowed in the 28%. I got housing expenses allowed in the 36%. Only one of them can be an answer. Opposite World says the maximum housing expenses allowed will be the lower of the two numbers. Which number is lower?
1490.
1490. So what are Brian and Margaret? What will be their approved housing expense? 1490. Which one is less risky to the lender? Brian and Margaret that have housing expenses of 1700, or Brian and Margaret that have housing expenses of 1490?
1490.
The 1490 is the less risky to the lender. Put your lender hat on when doing lender math. So they will be approved. In the terms of this loan, their maximum housing expenses will be $1,490. Questions?
I have one. Why are we subtracting the monthly income?
Because the lender cares about, and you're not subtracting the monthly income, you're subtracting their
Yeah, I'm sorry,
reoccurring
the
obligations.
reoccurring. Sorry.
Because the housing, that allows the lender to look at housing expenses versus housing expenses. We took out that reoccur. We have to consider it. But bottom line, what does the lender care about? Housing expenses. So for them to do this true side-by-side comparison, we got to compare housing expenses to housing expenses. We do that by deducting the reoccurring obligations. So now the lender's saying, Brian and Margaret, they both fall under the 28-36%. Now the question is, what's their allowable housing expenses? 1703 versus 1490. The 1490 is less risky to the lender. Other questions on this one? The last piece then is to solve for monthly income. We're going to solve for all three X's while we're here. So the last piece is to solve for monthly income. And again, to solve for monthly income, there's a couple things we need to take into consideration. We will do a very nice side-by-side comparison in just 1 second. The last piece that you could be asked for is the minimum income. Formula on the right, T-bars on the left. Now what we're solving for is the lower left, the minimum income. We know our qualifying ratios. The number on top is going to be housing expenses. The number in the other one is going to be housing expenses plus reoccurring obligations. The last time we subtracted it, this time we're going to add it in. So to find the minimum income under the top ratio, the 28, we take our housing expenses and divide it by 28%. For the second ratio, we take our housing expenses plus our reoccurring obligations and divide it by 36%. What we are solving for is the minimum income allowed for these terms. Again, opposite world. If we're asked for the minimum income, which one are they going to get approval under? They will be approved for the higher of the two numbers. With your lender hat on, which borrower is less risky? The one that makes more money or the one that makes less money? The one that's less risky is the one that makes more money, the higher of the two numbers. So we got to solve for both, run both ratios, always run both ratios. The lender needs to make sure that the borrower has the income to not only pay them, but to also keep paying that reoccurring debt. So they will get approved for minimum income with the higher of the two numbers. Yes, I heard a question.
What does RO stand for?
Reoccurring obligations.
Okay. So is that different than expenses?
Expenses, obligations, debt, it's all the same thing. Reoccurring expenses, reoccurring obligations, reoccurring debt. So whether you're a formula person or a T-bar person, here you go. We good so far? Look at our sample together. So Charles and Hannah want to buy a home with a PITI of $1,900 per month. PMI will be $60 per month. HOA dues are $600 per year. Recurring debt is $1,100 per month. What is the minimum monthly income they need to qualify using their ratios of 28 and 36%? Qualifying a buyer, I need 2 T-bars or 2 formulas, however you see it. Now what we're solving for is our income. 28%. There it is. 28%, 36%. And now we got to figure out what goes on top. The 28% only looks at housing expenses. So you have for housing expenses, what do we say they consist of? PITI, HOA, and PMI, if applicable. I got it all going on in this problem, don't I? So we got to take into consideration their monthly PITI. We have their monthly PMI, and then I have annual HOA dues. Does everybody see what they like to do to you? These problems are always solved monthly. So given annual HOA dues of $600, you divide that by 12 and you get monthly HOA dues of $50, which tells us their total housing expenses is $2,010. PITI, HOA dues if applicable, PMI if applicable.
So where's the 50 come from?
I took my 600 annual HOA dues
Oh, and divided by 12.
and divided by 12. The second number looks at housing expenses plus reoccurring debt. We've already decided my housing expenses are $2,010. I got a recurring debt of $1,100. So when we add that up, we get our housing expenses plus our recurring debt of $3,100. That fourth line on the T-bar means divide. So I take my I take my housing expenses divided by our 28%, and I get income allowed under this ratio of $7,178.57. And then we look at our second ratio. That fourth line means divide. So you take 3,100 divided by 36%. And I get monthly income under both ratios. The question wants to know what's the minimum monthly income needed. I got two numbers, only one of them can be the right answer. So looking at these two numbers, which one are Charles and Hannah going to qualify under? The higher of the two or the lower of the two? They're going to qualify under the
Higher.
higher, that's right, of the two. So what must their monthly income be in order to purchase this home? Their monthly income must be $8,638.89. Which one is less risky to the lender? The one that makes $7,100 a month or the one that makes $8,600 a month? The more money you make and the less debt you have, the more intriguing you are to the lender, the less risky you are. So when it comes to these, you got to solve for both X's. These are called multi-step problems. And you got to solve for both X's. You get two answers. And then based on what I call opposite world, we need to figure out which one they will actually be approved under. This is a lot, you guys, and I get that. They do not give me time to talk about this, which is why, unfortunately, we have to go through fast. I will share this with you. You're not going to see this math on my end of class exam. Woo, am I in a good mood today? I can almost promise you, you'll see this on your state exam. So make a note right now. Don't hurt yourself over this yet. Remember, we're recording. So when you're preparing for your state exam, come back to today's recording at about 11:25 a.m. and go through this again, and I will show you practice where we have practice in just a second. So if we do a nice side-by-side comparison, question says if any three of these could be a candidate for the end of the exam, yeah. So we first found the qualifying ratio, made sure they were under the 28.36%. Then we found the maximum payment, and then we found the minimum income. All three of these could be candidates for your state exam. Questions? Yeah, to repeat, you're not going to see this on my end of class exam. I'm in a really good mood today for me to say that twice. You may see this on your state exam. Is everybody good? I'm trying to help, not make things harder. Does everybody have a note? October 19th at 11:25 a.m. Is everybody ready to be done with financing? Woo! There we go. Those key terms at the beginning of Unit 15. Know what the words mean, flashcards. Look them up. You guys got a glossary in the back of the book. Have y'all found that yet? There's a glossary in the back of the book. If you don't know what a word means, look it up. If you don't know what a word means that's not in your glossary, you have a phenomenal tool at your disposal called Google. Look it up. Key point review, page 436. Student quiz is on page 439. Math in the student quizzes. Unit 15 has math concepts starting on page 431. Again, old book people, you do not have qualifying a buyer math in your book. Old book people, look in our Julie folder in the online learning system, and you got those pages scanned in for you. And then those 50 problems in the back of the book, these are the numbers that relate to the math that we just did. So you got unit 14 math back there, you got unit 15 math. But wait, there's more. If we look in the online learning system, under the unit 15 material, there's that practice amortization schedule that we looked at on Tuesday, where you can amortize using those 3 steps, and you can amortize this monthly for practice. There's some additional math practice, a financing math worksheet with solutions, of course. Don't study the solutions, but have them there to help you. Here's another financing quiz, extra practice, da 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 da. So please be utilizing the online learning system. Practice, practice, practice. Questions? Let's take our last break. We get to leave at 1 today. So let's take our last break. When we come back, we're gonna, I got a few things to share with you guys, and then we're gonna get started in unit 21. So let's take 10. All right. We're back. So we're going to, I got a couple things I want to say. We are going to get started on 21, and then we're going to leave talking about not next week, but the following week. Actually, we are going to talk about next week too. We just won't be together. So I am taking attendance. Let's see. You guys want a present? Who wants a present? Me. Okay. In the online learning system, if we scroll down, I know I'm getting ahead, but I think we can start looking at these things now. We got more math to do in unit 21 when we come back. After we get through 21, we are through most of the math. I did not just say all the math, but once we get through 21, we're through most of it, which means we've been through a good chunk of it so far. There's good news, right? That's not the present. If we look at the online learning system and we scroll down here near the bottom, you guys see a folder called math. And under the math folder, we have something called a math workbook. So under math, we're looking at the math workbook. And the math workbook takes the different maths and it breaks it up. So it gives you an explanation. Here's a formula. This is tax calculations that we saw in unit 3. And then it gives you some additional practice. Prorating on taxes we'll talk about. They got area and volume calculations. So this is our unit 4 math. There's commission math in here, seller net. So this is a math workbook to give you extra practice. This does also include the solutions. So again, you can check yourselves if it loads and see how you did. That is not the gift. It's here, I promise. It's just not loading right now. If you come across math that we haven't covered yet, for example, proration problems, we're getting there. This is something we'll see in unit 21. So if you're looking at the math workbook and you haven't come across, we haven't talked about proration math yet, then just skip it and know to come back. That's not the gift. Y'all ready for the gift? The gift is the first page of the math workbook. If you don't do anything else with this math workbook, look at the first page, because the first page tells you the math that you can expect to see when preparing for your state exam. The first page also gives you the math you can expect to see when you're preparing for my exam. So if you want to know how to break the math down, how to focus your energy in math, page 1 of the math workbook. So for example, on our exam, you don't see qualifying a buyer math. So my question to you is, why are you putting all your energy into it right now? Is everybody with me? Once you get through my exam and you're ready to go take your state exam, now you're going to put your energy in qualifying a buyer math. So if you don't do anything else with this math workbook, use page 1 to help you know where the different maths are, what the different maths are, and how to focus your energy. Question comes in, how many questions can we truly expect to see on the test? So if we go back to our Relink book that gives us the breakdown per topics on page 16, on your state exam, you can expect to see 8 math questions. My exam, it's 8 or 10. I don't remember. I think it's 8. So how many? There it is. And remember, you guys, you can miss 8 questions and still pass. I don't want anybody stressing or losing sleep about the math. Use it to your advantage. If it's not advantageous to you, focus on the other stuff. You can miss 8 and still pass both exams. Is everybody good? I want y'all stressing out over agency and contracts, not math. If math is your thing, if you get the math, if you understand the math, if you have time to practice the math, then you can get yourselves a couple extra questions. So the math workbook helps you focus your energy, page 1. And in addition, it gives you extra practice, extra explanations. If you're struggling with the math, consider going through the math workbook and seeing what it has to say about the math. The end of units have those math concepts that talk about what it has to say for each math. Let us help you. Is that a good gift?
Thank you, Julie.
Cool. The other thing I wanted to share with you guys, I mentioned and I forgot to mention this, and I do apologize. When we were talking about applying for your state exam, going to take your state exam, there are a couple other resources that I want to let you guys know that are available if you're looking for other study material. Now, don't open your wallet and start spending a bunch of money on study material if you haven't even first looked at the book or the online learning system. You guys have already paid for and received those tools. So before you go out and spend more money, make sure you've been through the book and the online learning system. If you're looking for something else to study, I have a couple suggestions. I understand you can go to Google and you can search study material, but guys, I can't validate the internet. I can't guarantee that everything you find on Google is going to help you pass your state exam. We know how Google works, right? There's a lot of crap out there. So if you go to Google, I don't know what you're going to find. I don't even know if you're going to find stuff specific to North Carolina. You go to Google, you might find Florida real estate law. Is everybody with me? So don't spend your study time looking for things to study. The book and the online learning system. If you're looking for additional material, though, I'd like to make a couple recommendations. One is the author of your textbook. The author of your textbook is Dearborn. And if you go to Dearborn, they have an app that's available that offers additional test questions, kind of like the interactive ones you have in the online learning system. So you select the answer and it tells you if it's right or wrong and why. You can get more here. There's a cost, there's a free trial, I believe. I don't know any of those details. But what I do know is the author of your book offers an app. You may want to consider going and looking at it. The other resource to consider, when you guys picked your book up from Lane, you had a flyer in there that included a program, a product called Exam Smart. I know it's backwards for you right now, but Exam Smart is a company that offers help in your exam prep. Again, there's a cost. I don't know those costs. I don't know what comes with it, but it will help you. They offer practice questions. They have videos, flashcards, da-da-da-da-da. So you may want to check out Exam Smart. Question comes in. Most math comes from units 14 and 15. I haven't sat down and figured out the math, but we just covered a lot of math in 14 and 15, right? So that would stand to reason. I agree. So the app, the Dearborn app, you may want to consider. The Exam Smart program, you may want to consider. I can't guarantee if you guys find anything else out there. Y'all want to hear a heartbreaking story? I had a young lady in my pre-licensing class many, many years ago, pre-pandemic. And she comes up to me one day and she's so dang fragile and frustrated. And I said, honey, what's going on? And she said, and what you say and what I'm studying, and I don't know what to believe, and I don't conflict. And I said, oh my God. I said, well, what are you looking at? Well, I went to Google for real estate and I've just been watching videos. And I said, what videos are you watching? Short story long, my girl was watching videos from instructors in Florida. No wonder the poor thing was so dang confused. So if you insist on going to Google, if you don't like the tools that Lane and I have available for you, and you insist on going to Google, please make sure that you're specifically looking in North Carolina. At least do that for yourself and not trying to study Minnesota state licensing or something. They're all different. Stay here. Questions? By show of hands, how many of you are feeling overwhelmed right now? By show of hands, how many of you feel like you got a lot of information coming at you? By show of hands, how many of you feel like you're drinking from a fire hydrant? I see most hands. Guess what, you guys? I've got good news. You have over a week to get yourself caught up. No class next week. Is everybody good with that? Don't try to log on to Zoom. We won't be here. This is not a weekend, Thursday to Tuesday. So we got Friday, Saturday, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. So we're like 12 days before we see each other again. This is not a 12-day break. You guys have been given the gift of time. Use our time off to get yourselves caught up. If you are caught up, use our time off to look at the rest of the material. Because when we come back, we still have the rest of 21, 17, 13, 11, 12, 19, 18, 16, and licensed law and commission rule. We keep going when we come back, and things are going to seem like they're happening fast because we're going to get through these units a lot faster because you don't have as many test questions. They're not as heavily tested. So things are going to happen when we get back. And I hope you guys appreciate and utilize the time off that we have off, the time that we have off, so you can get yourselves ready to finish out the class the rest of November. So please use this time to your advantage. I got to tell you, previous classes, sometimes you guys come back to me in 12 days and say something like, I didn't get a chance to study the whole time we were gone. You know what you did? You just lost everything we've covered so far. And now you got to work even harder effective October 31st to not only get yourself caught up, but to get yourself ready for that November 16th exam day. So please use this to your advantage. Can I get thumbs ups? That's the plan for the next 12 days. Take time, have some fun, go do something fall, right? But you got to stay in the book too. YouTube channels, reviewing the book, online learning system, a couple other resources I shared. Even though we won't see each other for 12 days, I still do encourage you guys to reach out to me if I can help. Send me screenshots. Let me help you. If you have a question that you're stuck on, take a picture, a screenshot, send it to me. While we're gone, my availability may not be as quick, but I will get back to you. So just please be patient with me. Probably generally checking emails in the morning or so. So if you email me in the afternoon or evening, I may not be able to get back to you until the morning. That's where we are. Are we going to take advantage of this? I hope so. Y'all don't know how lucky you are. You're the only class I teach a year that has a week off. So use this to your advantage. Everybody good? Questions, comments, concerns? Did I ruin your fall break plans? Okay, good. So we are, big deep breath, going to get started in 21. We won't get through it today, but we are definitely going to get started in it. A couple of things I'll have you guys look at, because you're going to look ahead at the rest of the material anyway, might as well. We're going to cover it eventually. But we do have, we won't see any of the math in Unit 21 today, which means we'll see that when we come back. By the way, the next time we come back is October 31st. So we get to spend Halloween together. That'd be fun. All right, so Unit 21. Unit 21 might be my favorite, because Unit 21, we get to go to closing. Yay, this is a good day. We have been building up to this. We started by creating agency. We put our buyers and sellers under contract. We got our buyer's loan approved. So now the next thing we need to do is close this transaction. So in Unit 21, we're going to talk about that contract to closing process and what settlement and closing look like. So our guide or our roadmap in Unit 21, we're going to describe some pre-closing procedures. This is also known as the contract to closing process. We're going to spend a little bit more time with TRID, which is the lender law. And then the star of Unit 21 is to calculate a mini settlement statement for your exam, both my exam and your state exam. You're going to get a question, and that question is going to ask you, how much does the buyer have to bring to closing? And that's what we're going to learn to calculate. We're going to look at the buyer's debits. We're going to look at the buyer's credits. And based on that, we're going to figure out what they need to bring to settlement to buy this home. So let's start talking about the contract to closing process. And when I'm talking to buyers and sellers, and we talk about the contract to closing process, I use the visual of talking about working gears. You guys have all heard the expression, it takes a village to do whatever. Well, guess what? It takes a village to buy a house. There's a lot of people involved, a lot of working gears to make this happen. So if we give each gear a role, so let's say one of these gears is the listing agent with the seller. One of these gears is the selling agent with the buyer. One of these gears is a lender. Here's our home inspector, our appraiser, our surveyor, our pest inspector, the radon guy. Everybody involved in the contract to closing process gets a gear. With working gears, what happens if one of these gears stops? The whole thing stops. A big part of our job is to keep these gears going. A big part of our job is to keep everybody doing what they need to do to get through that contract to closing process. The contract to closing process is everything that happens from the day that we go, the time that we go under contract, to the time that the buyer's new deed gets recorded, and everything in between. And like I said, a big part of our job is keeping these gears moving. So understanding, first off, a couple of things. We've already defined settlement versus closing. You guys in your books have excerpts straight from the offer to purchase and contract that define settlement and closing. Remember, settlement is when the attorney collects signatures from the buyers and sellers. Settlement is when the attorney collects money from buyers and sellers. Once we leave the attorney's office, then the attorney proceeds with closing. And closing involves a number of events, such as settlement. The title insurance update. Make sure you review Unit 5. I don't know why, but Unit 5 tends to get forgotten. So Unit 5 talks about the attorney's role with title insurance and performing searches in the public records. The very last act of closing, when it's all said and done, is when the attorney records the buyer's new deed. Then and only then is it a done deal. For our closing attorney, also known as our settlement agent, for our settlement agent, the buyer hires the closing attorney. The buyer hires the settlement agent in the closing process. The closing attorney works on behalf of the buyer. If the buyer comes with a lender, the closing attorney also works on behalf of the lender. The closing attorney's number one responsibility for their buyer client is to ensure they're getting clear marketable title. That's the attorney's role. This is why they do the title search. This is why they look in the public records. This is why they do what they do, is to make sure that their buyer client gets clear marketable title. Sellers in a typical residential transaction, it's not uncommon for sellers to let the buyer's attorney do what they need to do. They got to get their documents ready. They got to get the deed prepared. And it's not uncommon for the seller to let the buyer's attorney do that. If you get into a commercial transaction, buyers and sellers generally come with their own attorneys. If you get into like an estate, sellers may come with their own attorneys. So while it's not uncommon for the seller to let the buyer's attorney do their thing, understand that the seller is always welcome to hire their own attorney. You can always bring your own representation to the table. But the attorney, the closing attorney or the settlement agent that we're referring to is going to represent the buyer. Buyer's agents, remember, as soon as we went under contract, first off, do your little mini celebration. We got to celebrate the small wins along the way. So you go under contract. Buyer's agents, get that thing immediately to the lender so they can start on their thing. As soon as you get the contract to the lender, go ahead and send it to the attorney so they can start their thing. They're going to want to do that preliminary title search so they can have time to get with the seller and correct any issues that may come up. We also need to go ahead and schedule settlement. Even though we may have a delay, maybe we will, maybe we won't. But part of the contract, buyer and seller agree to the settlement date. So when we go under contract, we can go ahead and get this scheduled, understanding that we may have to change this out. So we're getting to closing. Buyer hires the attorney. Buyer's agents are getting the attorney and the lender the information they need to start the contract to closing process. I hear you guys, and I hear you loud and clear. Julie, this is all fine and dandy, but when do I get paid? We don't get paid until it closes. And what does closing constitute?
When the deed is recorded.
When that deed is recorded. So when do we get paid? Only when it's a done deal. As you're refreshing this week, you'll be reminded there's a time when we earn the commission versus when we actually get paid. Do not go to settlement and ask the attorney, where's my check? The attorney doesn't have your check at settlement. The attorney will have your check after they record the deed. When that deed is recorded, you'll get an email from the paralegal or the attorney. It's my favorite email in this whole industry. And it's short and it's sweet and it's to the point. And your email will say, we are on record. That's when you know it's done. That's when you know you can go back to the attorney's office and get your firm's commission check so you can get paid. You go to the attorney's office, pick up your firm's commission check, you take it to your firm processes it, and you get your commission split. Another really big piece during the contract to closing process is the buyer's due diligence process. Don't write this down. This again is in the offer to purchase and contract. That's why it's italicized. It's also in your book at the beginning of Unit 21. But just as a reminder that the buyer's due diligence process is their opportunity to investigate the property, to decide whether in their sole discretion if they will proceed with or terminate the transaction. So we need to have the buyer doing everything that they can during due diligence to learn as much about the property as they possibly can. So the next little piece of this is going to take the buyer's due diligence process and discuss some of the things that they may consider doing to investigate, learn about the property, to decide if they want to proceed or terminate. I think it's important that we realize that this list is not inclusive. So if there's something that your buyer wants to investigate that's not on their list, never look at your buyer and say, you don't have to worry about that. It's no big deal. You are not the one buying this house. You are not the one that's going to make the mortgage payment. So if they want to investigate something that's not on their list, our answer is, okie doke, let's do it. Is everybody with me? That's how you old car right there. Let them investigate and learn so they can make that decision. Various things. 544 is new book people. Let me see. Old book people, where are you? Old book people, you are on page 520. So old book people, you're on 520. And again, a lot of these things we've already talked about. So this is good. So this just gives you a better understanding of that due diligence process, which is part of the contract to closing process. Again, if the buyer's getting a loan, the loan process is the longest part of the contract to closing process. So if your buyer's getting a loan, then we need to get that contract to the lender and let them start their loan approval. Tell your buyer that they need to be in communication with the lender. They can't ghost the lender. Y'all, I'm not kidding. I had a buyer once and the lender couldn't get a response. The lender called me at some point and said, Julie, our buyer won't call me back. Let me try. And I heard the story. I'm busy. I got work. I got family. I get all that. Is everybody else busy? Right? We all got something going on. But if you choose to buy a house, and you need to set aside time to get that loan approval. So we need to have our buyers find that time. They can't ghost the lender. The lender can't proceed until they've received this information that they're requesting. Also remember, you guys, with the buyer's loan, there are no built-in contingencies. So if buyer and seller agree to add a contingency that says something like, me buying your home is contingent on me getting loan approval, I don't have that in our contract. If you guys want to negotiate and add that, we have to have an attorney draft something up. We don't have verbiage for that. So no built-in contingencies, and that does include getting loan approval. As we mentioned earlier, it's really, really, really rare to get loan approval while we are still in due diligence. What we can get in due diligence is that loan to come through the first round of underwriting, so we can get an idea from the lender of how things are looking. And based on that lender's pretty good idea, the buyer has a decision to make: move forward with or terminate the transaction. If we find out after due diligence that the buyer's not going to get loan approval, we'll have to terminate. Seller will keep the due diligence fee, and now the seller's going to get the earnest money because we terminated after due diligence. So the buyer's loan, get going on this. Buyer's agents, get going on this. In time, as you guys are out in your careers, you'll meet lenders. You'll have lenders on speed dials. You'll know their time frames. So if you know this lender needs, 20 days for due diligence, 20 days to get through underwriting, you can adjust your offer accordingly. If you don't know this lender, if you've never worked with this lender before, pick up the phone and call them and ask them, how much time do you need for due diligence? Because what I'm going to ask for in due diligence for my buyer, I'm going to try really hard to get us through the first round of underwriting so we have that pretty good idea. And I can't always do that without communicating with the lender. Another big part of the buyer's due diligence process is the property investigation. Home inspections, for example. Is the property in an HOA? If so, let's get our hands on the covenant so they can review those. As mentioned, the home inspection. Understand a few things about the home inspector. The home inspector's job is to go into the home and point out the problems. Prepare your buyer for this. The home inspection report looks very scary, especially to a first-time home buyer. The home inspection report does not talk about all of the nice, pretty things about the home. The home inspection report points out the problems. The home inspector is not going to look at the buyer and tell them what a lovely home they're buying. So we need to prepare our buyers. Their job is to go in there and find problems. I tend to think of the home inspector as like your medical practitioner. You go to the doctor once a year for a physical, and they run all the tests, run the blood, da 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 da. Your general practitioner knows a little bit about a whole lot of things. But when you go to the doctor once a year, if they get a test result that throws a flag up at them, they're going to encourage you to talk to a specialist. Yes, the home inspector is the same thing. They know a little bit about a whole lot of things. And if they see an issue with electrical, they're going to suggest that the buyer talk to an electrician. If they see an issue with the plumbing, they're going to recommend that the buyer talk to a plumber. They're going to recommend, based on what I inspected as the home inspector, I suggest you talk to this specialist. The home inspector can't fix it, shouldn't fix it. They're not there to fix it. They're there to find the problems. So the home inspection, if you have an uncertain buyer, if they're not sure, I recommend having the home inspection done early so we know what it is that we're dealing with. Remember too, with the home inspection, the seller may have completed the Residential Property Owners Association disclosure statement, or what we call the RPODs. Regardless of how the seller completes the RPODs, the buyer should still be encouraged to have their own inspection. Even if the seller says, yes, this is broke, yes, this isn't working, yes, 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 yes. The buyer should still be encouraged to have their own home inspection done so they know for themselves. Another big piece of the due diligence process is securing homeowners insurance. If the buyer's getting a loan, homeowners insurance is required. And it's not just any homeowners insurance policy. The lender has to approve the homeowners insurance policy. So we need to get the buyer shopping around for insurance during due diligence. Because if the buyer or the property have a history of claims, insurance premiums may be high. And if insurance premiums are high and your buyer is about maxed out on their allowable expenses, homeowners insurance could tip them over that amount and we're not getting loan approval. I got a whole unit dedicated to insurance. So we'll talk about specific homeowners insurance in unit 13. Again, we want to encourage our buyer to shop around. Never look at your buyer and say, this is the insurance company you're going to use. Encourage them to shop around. Tell them to call Jake from State Farm. Tell them to call Flo from Progressive. Tell them to shop around and see what product they have to offer to see what's best for them. The lender will have to approve the homeowner's insurance, the policy, so they can protect their interests. And again, that's part of the due diligence process. If the buyer's getting a loan, an appraisal is required. The appraisal is actually the property of the lender. However, the lender allows the buyer to pay for it as part of their contract to closing process. They require it. That's how the lender knows how to originate the loan. Remember, they define value as sales price or the appraisal amount, whichever is less. So the lender has the contract that the buyer and seller agree to, but they kind of want a second opinion. And that's why they're going to require an appraisal. If it's a cash buyer, the appraisal is optional. We got a whole unit dedicated to the appraisal. When we get back, we will talk about unit 17. We talked about the survey back in unit 4. The survey helps us define the parameters. What are the perimeters of the line? Of the property lines. If the appraisal is higher than the amount sold for, is that good for the buyer? They're going to get approval on the loan amount or the appraised amount, whichever is less. So if the appraiser's higher, we're going to go for the sold price, which is what we're contractually obligated. That's what your loan amount will be on. The lender will approve the loan amount on the sales price or the appraised amount, whichever is less. Surveys can help the buyers identify possible easements, encroachments. All properties have some kind of easement. There's almost always a utility easement, for example. So surveys help the buyers identify that. If there's any encroachments that come up, we need to take care of it with the seller, get with the seller so they can address it. Remember too, you guys, with title insurance, if the buyer waives getting the survey done, if the buyer chooses not to have a survey done, and then they buy the home, and we find out after closing, for example, there's an encroachment, title insurance isn't going to help that homeowner. Title insurance is going to say, had you had a survey done before you bought, we could address that, taking care of it, and we wouldn't be here. You chose to waive that survey, so you choose to take on any consequences, such as an encroachment. If you want full protection from title insurance, get the survey done so they have that. Still in due diligence, still investigating and inspecting. If the property's on an on-site septic system, We want to get an improvement permit or a septic permit. These come from the county health department, wherever the property is located, that county's health department. As a buyer's agent, maybe the seller has it available to you, maybe they don't. But we need to determine, do a septic inspection. If nothing else, they can come in and pump the septic tank, inspect it, make sure there's no leaks, make sure it's still in good condition. By the way, listing agents, prepare your sellers for a septic inspection. Y'all know how they inspect a septic tank, an underground septic tank? They bring in the backhoe. I don't know another way to inspect a tank without digging down to it. So let your sellers know, because they generally get really excited if they don't know they're bringing the backhoe, and then they start digging up their front yard or backyard or whatever. They'll pat it down. They'll fill it back in and pat it down when they're done, but they got to get to it, you guys. Also, listing agents, remember, we can only advertise the number of bedrooms allowed per the septic permit. Bedrooms are based on the amount of people. And how many people do they figure per bedroom? How many human heartbeats do they figure per bedroom? They figure 2 human heartbeats per bedroom. So what I'm telling you is, if you have the septic permit allows for a 3-bedroom, what we're saying is that on-site septic system will support 6 people. We can only advertise the number of bedrooms allowed per the permit. Another thing all buyers should be encouraged to consider is a wood destroying insect report, what we often refer to as a pest inspection. The pest inspection doesn't look for all pests. Specifically, the pest inspection looks for wood destroying insects, termites, carpenter bees, powder post beetles. If the home inspector or the pest inspector see evidence of other pests, then they will report those. But specifically, what we're looking for with a pest inspection is wood destroying insects. You have a sample pest inspection, 547 or 522. No, new book people, you're on 547, old book people, 522. And this is just a sample. But you can see about halfway down, the pest inspector is going to identify if they have found visible evidence. We're not necessarily looking for the pests themselves. They're looking for evidence of the pests. That's what the wood destroying insect report is looking for. If there's concerns about other pests, then of course the buyer can address those during their due diligence. Also during due diligence, after all these inspections and investigations, the buyers learned a whole lot about the property, right? They spend good money buying a house to learn about the property to decide if they want to move forward or not. At the end of their inspections, they may ask the seller to do repairs. Shake your head, yes or no. Is the seller under any obligation to do repairs? Everybody shake your head no. The seller's not required to fix anything. Do you remember that very important sentence in our offer to purchase and contract that says this property is being sold in its current condition? What obligations does that give the seller to do anything? None. This property is being sold in its current condition. If the seller agrees to do anything, we say, thank you very much, understanding that they don't have to do a thing. Prepare your buyers for this. Buyers don't like this. You find a whole laundry list of things wrong, and the buyer's going to say, well, the seller's going to fix this. Maybe they will, maybe they don't. Maybe they agree to fix it all or none of it or some of it. Repair requests, I usually call this round 2 of negotiations. So repair requests, we're entering into another round of negotiations, trying to get buyer and seller on the same page. If the seller agrees to do anything, I'm talking change a light bulb. If the seller agrees to do anything, this property is no longer being sold in its current condition. Now this property is being sold under the understanding, this condition with a new light bulb. So if we agree to do anything, we need to have all parties complete and sign the due diligence repair request agreement. If the seller agrees to do any repairs, we need to have that agreement in writing and signed by all parties. That makes the seller contractually obligated to do the repairs before settlement. And we have amended that one teeny tiny sentence in our contract. Now the property is going to be sold under these repair agreements. We must have the repair request agreed to in writing and signed while we're still in due diligence. We got to have everybody agree to any repairs while we're in due diligence, because remember, all due diligence is for the buyer to decide, now knowing what I know, do I want to move forward with or terminate? And if the seller agrees to do any repairs, if the seller agrees to do no repairs, that's all information that the buyer needs to take in to decide, now knowing what I know, do I want to move forward with or terminate this transaction? As said, the repairs themselves don't have to be complete until prior to settlement or whatever the parties agree to. We just got to have them agreed in writing while we're in due diligence. Yeah, Cody.
If they agree to do all the repairs, does the buyer have the right to come in and have it all inspected then?
The buyer is, yes. And that does address that, because the seller has a duty to perform these repairs in a good and workmanlike manner. What the heck does that mean? Couldn't we all have different definitions on what's good and workmanlike manner? Really, it's supposed to be per building code, like the right way to do it. But no matter, yes, the buyer is encouraged to go have those repairs checked after they're done. The buyer can go put eyes on them. A lot of times the home inspector for a lesser fee will agree to go back out and just check that whatever we had fixed. So they're not doing a full-blown home inspection. But if your buyer's not an electrician and they need electrical work done and they can't look at it and tell if it's good or not, they may want to consider having that home inspector go back out, you know what I'm saying, and give them that good bill of thumb. But to answer your question, yes, buyers should be encouraged to have those checked. So again, the repairs themselves don't have to be complete until prior to settlement or whatever the parties agree to. Anything and everything is negotiable. Sometimes the parties can agree to in lieu of repairs. The seller may offer to pay some of the buyer's closing costs, or maybe we reduce the purchase price. So there's other options we have to try to get buyer and seller together if the seller's willing to negotiate this. Remember, the seller has every right to say, no, I'm not doing repairs. No, I'm not doing in lieu of repairs. No, no, no. Please prepare your buyers for that. That doesn't tend to be good news for the buyers. They don't have to fix a thing. So if they agree to do anything, we say, thank you, understanding that they didn't have to. Anything else on repairs? That due diligence is the buyer's right to terminate for any reason or no reason up until 5 p.m. on the due diligence date. Due diligence date is defined in the contract. After the due diligence period, the buyer loses the right to terminate. Because they're past that due diligence period, if they terminate for any reason, they'll still lose their due diligence fee, but now they're going to lose their earnest money deposit as well. Let's face it, you guys, nobody likes to terminate. But as a buyer's agent, if we must terminate, the best thing I can do for my buyers is terminate while we're still in due diligence to give them their earnest money back.
Mo.
Oh, Got an
Come on.
accident. Hang on.
Kelly,
hang
go.
on, hang on.
Out.
Okay. Who knows what we might hear? Okay, so so as a buyer's agent, if we must terminate, the best thing I can do is terminate while we're in due diligence so I can get my buyers their earnest money back. Something's better than nothing, right?
I have a question.
Yeah.
With your example that you had earlier, where you talked about a lot of times, particularly with loan approval, and I know if I'm recalling correctly, with FHA, they may have requested that, you know, there's an inspection or termite inspection or something like that.
Mm-hmm.
And that doesn't happen, or the let's say even the purchase contract is contingent upon loan approval, but that doesn't happen until outside of the due diligence timeframe, then they're going to lose their earnest money in that example. That's correct?
Yes, if we find out after due diligence that you're not getting loan approval, you're in breach. You lose your due diligence and your earnest money. This is why I want to get you through the first round of underwriting while we're still in due diligence. So at least we have a pretty good idea from the lender. If the lender's saying, I think this looks good, you just need to submit 3 more documents, the buyer may feel okay proceeding. If the lender says, this isn't looking good, the buyer's got a decision to make. Because if we don't find out after that we're not getting loan approval, they lose their due diligence and earnest money. There are no built-in contingencies. And again, if you bought a house 20 years ago, there was a loan contingency. We don't have that anymore. And that's what I know a lot of this is I got to unwire what you knew when you bought your house 20 years ago. So
Right.
Today, that loan contingency, no more. Unless the parties agree to add it. Anything is negotiable. Thank you, Dee. Yeah. Physical inspection by the property. Again, you guys, the buyers should be encouraged to go to the home multiple times during the contract to closing process. We should be encouraged to meet the home inspector, to talk to the different people doing the inspections. What if the buyer wants to do furniture placement? What if they want to bring their measuring tape? What if they want to look at paint samples? What if they want to bring mom and dad? Every time we can get them to that property, they're seeing something that they didn't see the time before. So the more times we can get in there, so y'all don't think you're going to show them the house once and then close in 60 days. We have a duty to keep them back. Whenever they want to go see it, we have to go with them. We can't have the buyer showing up at any time during the day. It's not their home yet. So we still need to be respectful of the fact that somebody else owns it. Somebody else might even be living in it. So we schedule a showing. We schedule time for the home inspector. We schedule these trips to the house. The buyer should also be encouraged to drive through the neighborhood at different times of the day. We bought our house 3 years ago. I drove by, I set my alarm one morning. I drove by here at 6 o'clock one morning, got up, got me a biscuit and a coffee, and drove down here at 6 o'clock in the morning to see what this house looks like at 6 o'clock in the morning. You know what we did one Friday night at 10 o'clock? We came over here. They should be encouraged to drive by the home, drive through the neighborhood at different times of the day, different days of the week. Is this a party neighborhood? Well, if so, we're going to find out on Friday or Saturday night. Everybody with me? So this physical inspection of the property is ongoing from the first time you see it up until the final walkthrough on the way to settlement and any time in between. I've got to stop here because I got 2 things to say. We will pick up here on October 31st. Also on October 31st, we get into the math of Unit 21. New book people, please turn to page 587. Old book people, please turn to page 561. 587 to 588 is my new book people. 561 to 562 is my old book people. Let's call these pages your formula for the math that we're gonna do when we get back in Unit 21. And we got to start with knowing what's a debit to the buyer, what's a credit to the buyer, what's a debit to the seller, what's a credit to the seller. If you guys can spend time on these 2 pages, can you give me that in 12 days? Can you spend time on these 2 pages? If we can come into this on October 31st, having a better understanding of what's a debit to one party and a credit to the other, that's going to help make the math in Unit 21 much easier. So make it easier for yourself. Review these pages. Guys, I encourage you again to use this time to your advantage. Let me know if there's anything I can do. I'll miss you guys while we're gone next week, but we'll come back together on the 31st, knowing that we are heading towards the finish goal after that. So get yourself caught up, get yourself rested, and get yourself ready for the last 4 weeks of class as we blow through the rest of this material. Fair enough? I try to be honest. I've been called blunt before. I guess that's a fine line. I try not to leave you guys. Well, I didn't know this was hard. Everybody hearing me? Y'all have a wonderful week or so off. If I can help in any way, let me know. I'll see you guys at 9 a.m. on Halloween.
Thank you, Julie.
Thank you.
Thanks, Julie. See you
Thank
guys.
you.
Enjoy your week.
You guys too.
Thank you.